Disconnect.
Check, check, check.
All right, good morning, everyone. It's 11:02. I'm going to convene the public hearing of the Banking Committee today, this Tuesday, February 24th. Welcome, everyone. Hope everyone is dug out okay. I may need to borrow somebody's snowblower next time myself because I made it through my driveway, but sadly had a cable break or something like that. But nonetheless, I'm all dug out. Hope everybody else is dug out as well and safe and warm. And happy to have a good crowd here today. I expect we will have more remote participation as people are still digging out throughout the state. So first, I do want to recognize my co-chair, Senator Miller, who is joining us online, and invite her to say a few words. Madam Chair.
Thank you. Oh, I'm sorry. Thank you, Mr. Chair, and good morning, everyone. I'm sorry I couldn't be there in person. That was my plan, but Mother Nature had another plan. And so I just want to say welcome. I'm excited to hear the different points of view on the legislation or the bills that we're proposing to the committee this year. So thank you, and let's get going, Mr. Chair.
Thank you, Senator. Ranking members like to say hello?
Sure. Defer to the older and wiser.
You're deferring to the older and wiser
I am.
member? Well, this is always the most interesting part of the whole deal. Hearing what the people have to say, hearing what is the good, the bad, and things that those would consider ugly. So I'm looking forward to an interesting morning and afternoon. And Mr. Chair, I think it's almost time to go.
Thank you, Representative. Senator Patel.
Hey, good morning, everyone. I too was digging out. I apologize for my more casual look today. We had snow, and I know the shore got hit pretty hard, but we had some big snow by us. It's good to see everybody. I expect that we'll have a very productive public hearing. I see a lot of familiar faces in the audience, and this committee is arguably the best in the building with respect to getting its work done and coming to consensus very easily on a lot of things that come before us. So with that, Mr. Chairman, let's go.
Thank you, Senator. That's right. Neither sleet nor rain nor snow.
4-foot snow.
Actually, I shouldn't jinx us, but we have had been unlucky in past years with the building closures and weather cancellations and everything. So knock on wood, we're on track for now. So with that, I would like to turn to our speaker list and call first on our list, the Connecticut Department of Banking, represented by Matt Smith here today. Morning, Matt.
Is this on? Okay, good morning, co-chairs Doucette and Miller, ranking members and honorable members of the Banking Committee. My name is Matt Smith. I am the Director of Government Relations at the Connecticut Department of Banking. And I'm here today to talk to you about two bills, SB 219 and HB 5210. Senate Bill 219 looks to make a clarifying change to the rental security deposit statutes, reaffirming the commissioner's authority to impose civil penalties. While the commissioner already has this authority given to him by anyone subject to the provisions of the jurisdiction of the commissioner set forth in 36A-50, this language makes it clear within the rental security deposit statute, which is set apart from Title 36A. And I want to come back to that in just a moment. The other bill, HB 5210, is basically a conforming change to federal law that codifies in the Connecticut statute compliance with the FTC's safeguard rule. This is already in place at the federal level. We already enforce it here in among our regulated entities. And basically, this requires entities subject to the commissioner's jurisdiction having set forth in place policies and procedures around data security and protecting consumer information. It does impose a new requirement to notify the banking commissioner if there is a data breach, which within 3 days, and it removes from the FTC's safeguard rule a threshold of 5,000 5,000 consumers that people are responsible for their data. And it removes that so that everybody, particularly within our consumer credit division, our licensees are now subject to having policies and procedures set forth to safeguard data. Back to the rental security deposit bill, I want to make clear that this is not a change. What it does is it just codifies it in the rental security deposit statute. The way the rental security deposit statute is written is that when the commissioner is investigating a complaint as given him the authority in that statute, landlords are subject, and the language is unambiguous. It says landlords shall be subject to the provisions of 36A-17 and 36A-52. 36A-17 gives the commissioner the right to investigate, and he has all the investigated powers laid at him. 36A-52 allows him to issue notices of cease and desist, order of hearing, notice of hearing, et cetera, and lays out, pretty much makes them subject to our right of hearing and all of that. It gives landlords the right of hearing and all that. It makes it just like another enforcement action for the Department of Banking. Again, there is no change. The maximum violation for violating Connecticut banking law is $100,000. That's why that is written there, in the raised bill. This has always been the case, and it is that statute that says that landlords shall be subject to the provisions of 36A-17 that gives us the authority to impose a civil penalty of up to $100,000. That has never happened in the history of the department, but I just want to make clear that there is effectively no change to existing law. With that, I'm happy to answer any questions.
Thank you, Mr. Chair. And thank you, Matt. What is the highest penalty that you have to date? You discussed the fact that it's on the books and typically you're not going to be actually utilizing that penalty, but what kind of penalty have you seen to date?
Oh, rarely do we even impose a civil penalty. It's happened a few times. Our primary goal in adjudicating these disputes between landlords and tenant is to make sure that the tenant gets their security deposit back if there is a violation, if we found that there's a violation of the rental security deposit statutes. Typically, what we would do is give twice the security deposit as a fine. So how these would generally run out, if there is found that the landlord has violated the statute, the tenant is entitled to twice the security deposit. We would then impose a fine of twice the security deposit. So the landlord would pay twice the security deposit to the tenant and then pay a civil penalty of twice the security deposit.
Is it safe to say that that's few and far between?
Few and far between, yes. And really, we don't go beyond twice the security deposit. I don't recall a case in the 10 years that I've been there that we've done anything beyond twice.
Thank you for your comments there, and I appreciate that.
Sure
Thank you,
thing.
Mr. Chair.
Senator Miller.
Thank you, Mr. Chair. Good morning, Matt.
Good morning, Senator.
Matt, I have a question. So you said there's no change, but when you look at the bill, it's adding the civil penalty not to exceed $100,000. So if it's existing law, why do we have to add this today?
It's more in the name of like transparency. So if you're a landlord and you're looking at the rental security deposit statute, it doesn't enumerate particularly in the security deposit statute that they can be subject to a civil penalty. And that's what this does. If you're a landlord and you're reading through it, then you'd have to go back to 36A17 and then read the banking law and then go to 36A52, read the banking law there, which, can be, it's maybe not the easiest read, right? So we just
Mhm.
want to make it clear, that this power, this authority does exist. So it's sort of just in the name of maybe transparency might be a good way to couch that.
So can you, for transparency for the public, can you cite, is it 36A50 or 36A52? I assume that it's 36A50 where it talks about the penalty, the commissioner's authority.
Yes, 36A50 and then 52 talks about the it's more procedural, the right of the commissioner to issue an order of cease and desist, make restitution, I think, and notice of right of hearing. And those are powers that we use during an enforcement action, against any person who may be violating banking law.
So for clarification purposes, when you look at the bill, 36A52 is existing. So we're not
Yes, yeah,
adding that. So that is
Correct,
in law. So
correct.
I just wanted to make that
Correct.
clear for the public that it is existing. We're not adding that. We are adding 36A50. So thank you very much, Matt.
Okay, great.
Thank you, Madam Chair. Any other questions for Matt? I think that's it. Thank you, Matt.
Perfect. Thank you very much. Have a great day, everyone.
You too.
Okay. Next on our list today is Representative Jacobson, who I see is joining us online. Welcome, Representative. And you're on mute, Jonathan.
Of course I am. Thank you, Mr. Chairman. Good morning, Chairs Miller and Doucette, ranking members Berthel and Delnicki, esteemed members of the Banking Committee. I'm State Representative Jonathan Jacobson, representing the 148th District in Stamford. Sorry for not being there in person today. That was my intention, but unfortunately, the recent weather event has unfortunately kept me local. I'm here today to talk about the Bill 5211. As some of you may recall, last year, I testified before this committee urging stronger regulation on the sales-based financing industry, an industry also known as a merchant cash advance. At the time, I compared the industry to the Wild West. I no longer believe that to be a comparison that is accurate. Today, I view the industry to be nothing less than the golden age of piracy, with the state of Connecticut becoming a main port of call. I say that not as a casual observer, but as a practicing civil litigator and small business owner. I represent small businesses and individuals across the state and around the country. And in that capacity, I've seen firsthand how these products, self-styled as sales-based financing or a merchant cash advance, are used to drain operating accounts, freeze personal and corporate assets without judicial oversight, and push otherwise viable businesses into collapse. I've seen employees lose their jobs and families lose livelihoods. I've seen businesses destroyed not by fair market forces, but by contract provisions designed to evade scrutiny and leverage payment through aggressive and at times unlawful collection tactics. But we're not alone in recognizing this problem, and it's far from a partisan issue. During President Trump's administration, the Federal Trade Commission and Consumer Financial Protection Bureau pursued enforcement action against sales-based financiers for their deceptive, unfair, and abusive practices targeting small businesses. Federal courts have also begun scrutinizing these arrangements, finding in certain cases that they function as disguised, usurious loans, which implicate federal civil rights and racketeering statutes like RICO. Just last week, NPR published a nationwide article characterizing these agreements as small business payday loans with terms that would, quote, make a mobster blush, end quote. Our sister state of New York has begun aggressively cracking down on the industry. As a result, we've seen an influx of these lenders into Connecticut, where certain actors have sought to exploit gaps in our statutory framework and the absence of clear guardrails to maximize profits. This legislation before you, Bill 5211, aims to restore transparency, reinforce due process, and ensure that our state is not a refuge for these bad actors. The bill proposes real transparency by joining states like California and New York to require an estimated APR calculation modeled under the Federal Truth in Lending methodology. Stated simply, if a product functions like a credit, it should disclose an annual percentage rate. That's neither radical nor novel. It's transparent and it's fair. Second, it closes what I view as a constitutional loophole. This bill would prohibit provisions waiving a borrower's right to notice, hearing, or prior court order before obtaining a prejudgment remedy of an attachment on assets. If a sales-based financer wants to freeze assets or attach bank accounts as part of their efforts to obtain a judgment for the breach of one of these agreements, they should go to court and obtain their attachment after a hearing before a judge like everybody else. Any other result is, in my view, inconsistent with fundamental principles of due process, particularly in an industry with documented predatory and even extortionate collection practices. Finally, it prohibits non-disclosure provisions that silence the voice of small business owners, and it further provides a modest cooling-off safeguard that can prevent irreversible harm. I will note for the record that the Attorney General and his office are in support of this bill, and I anticipate that a letter of support will be forthcoming. I also want to specifically highlight the written testimony submitted by Attorney Shane Heskins, a nationally recognized authority on merchant cash advance enforcement. In short, this bill does not ban sales-based financing. It simply requires transparency, basic procedural fairness, and constitutional guardrails. I believe it to be a meaningful step in the right direction to regulate an industry rife with bad actors and sends a clear message that Connecticut will not be a safe harbor for predatory financial actors. I respectfully urge this committee to support House Bill 5211, and I'm happy to answer any questions any members of the committee may have. Thank you.
Thank you, Representative. Thank you for your brevity as well, coming in under the 3-minute mark. And that was a good overview. We were here last year on this issue, and you also testified at that time, which we appreciate. I wonder if you wanted to take the opportunity to talk a little bit more about the prejudgment remedy procedures, your experience with it as a litigator. Again, just to refresh the memory of the committee of what that means and how that works, and what you've observed about that process.
Certainly. Connecticut has a somewhat unique mechanism in litigation when somebody claims that they're owed money. Before they even start a lawsuit, or sometimes after a lawsuit is commenced, they can go to a judge and say, Your Honor, I think I'm going to win my case. And in the event that I win, I want to make sure that I have money to collect on. It can be a bond, it can be a lien, or it can be money, or sometimes I've had inventory seized. It's a collateralization, a prejudgment remedy of an attachment. And what you do is you go to court with an application, and you have a full-blown trial on the merits right off the bat. The burden of proof is about as low as it gets. So in a normal civil setting, it's, preponderance of the evidence, which way do the scales of justice tip? Is it 51 to 49? Whoever has the 51 wins the case. In a prejudgment remedy hearing to attach assets, it's a trial, but the burden of proof is by probable cause, about as low as it gets in American jurisprudence. And when that hearing takes place, and the judge enters an order granting a prejudgment remedy after the other side has the opportunity to, for example, confront their accuser and be heard, aka due process, the judge would, under those circumstances, potentially order an attachment. And then the creditor, whether it be a lender or maybe someone who was the victim of a car accident, can then be empowered to collateralize the anticipated debt for a successful judgment after trial. That's what a prejudgment remedy of an attachment is. But that's not what we're talking about here. We're talking about what's actually the next step, because current Connecticut law authorizes in some circumstances where a borrower in a commercial transaction can waive their right to a hearing. What does that mean? That means that in certain circumstances, a borrower can contractually say that they don't need a hearing to get for the lender to get an attachment. So in practice, or I should say in theory, what's supposed to happen is there's an event of default as set forth in the agreement. And instead of going to court and having an evidentiary hearing and a court order of attachment, the lender's lawyer can sign an affidavit saying there was a breach, there was a waiver of a hearing, and I'm entitled to an attachment. And a marshal serves a financial institution freezing bank accounts. In this context, with a sales-based fining agreement, I find in my practice that though the language waiving a borrower's right to notice and hearing is standard boilerplate, it's basically in everything, in all these agreements that have a Connecticut forum selection clause or Connecticut choice of law provision. And what happens is that operating accounts get frozen, so payroll obligations can't be met, among other things. Many of these agreements have numerous guarantors, so other corporations, individuals, personal bank accounts frozen, and essential purchases cannot be met. And what's supposed to happen is this all takes place outside of the confines of the court, because there's supposed to be a mechanism in place where if you're on the receiving end of one of these, you're entitled to an expedited hearing. So if I signed one of these agreements, my assets gets frozen without a court order, I can go to court and say, Judge, I dispute this and I want an emergency hearing. That's how it's supposed to work on paper, but that's not how it works in practice. Currently, what happens is assets are frozen. A application to discharge the attachment is filed, and the court will schedule a status conference in 7 days. There's a significant backlog in our judicial system to have hearings to determine whether these liens are enforceable or whether the attachment was rendered in the appropriate amount in the first instance. And what ends up happening is you have these small businesses whose assets are frozen. They have to scramble to find some way to pay a private lawyer in Connecticut to contest these things. And it could take weeks or even months before a decision is rendered. All the while, their assets are frozen, exposing them to God knows what. So the practical reality, in my experience, is that these borrowers have no choice but to capitulate. They say, this is wrong, this is unjust, I dispute everything, but I need to pay my employees. I need to put food on my kid's plate tonight. I have to settle. And the leverage that's exerted is extraordinary. And unfortunately, there's also documented cases. I'm not going to go into any sort of ongoing litigation that I'm involved with, but as I referenced in my opening, that there is a body of recent New York District Court authority. And I will note that the Attorney General for the state of New York just recently was affirmed of in excess of $1 billion judgment, that's billion with a B, against lenders who would freeze assets and prolong returning it to court or giving the borrowers an opportunity to be heard in a deliberate attempt to extort them. Literal extortion. You want your assets unfrozen? That's cool. Pay me. That's what's happened before. Doesn't happen with everybody, but it's happened before. It continues to happen today. And the last piece that I'll note is that in theory, when you look at the statute, the sales-based financing statute that's this committee is proposing to be amended, it currently provides that you can't freeze assets without a court order if the amount is below $250,000. That's the current proposal, evidencing a clear legislative intent that some of these agreements are so onerous, burdensome, that or just potentially harmful, that we've already decided that there's a certain class that you can't have an attachment of assets without a court order on. Even that directive is being skirted. I'm not going to cite any cases or name any names, but I'll just say that I've seen firsthand the argument be raised that, well, because there's a comma here in this statute, the way this is worded there, I can actually freeze assets later without a court order. The real problem is that there's just not enough time for the judicial process to play itself out, to build a body of case law, to analyze the issue, to determine the issue, because that could take weeks or months. All the while, the small business has no room to operate because their assets are frozen. So what I see firsthand is disproportionate leverage being exerted on small businesses by a lender of money who in certain circumstances have these loans that have, while not a loan per se, because there's no end date and there's no fixed payment schedule, but if you were to incorporate the effective APR, like the New York State Court, the New York State and California State, and what is being proposed today, you see effective interest rates in excess of 100, 200+%. It shocks the conscience. So to have rates like these against small businesses that allows, and to further allow these lenders to freeze assets without a court order, is just too much. And I feel that, and I personally see that it is having direct, disproportionate harm on the viability of these businesses. And I don't think that's consistent with the public policy of the state. And that's why I believe that this legislature should act.
Thank you. Thank you for sharing your knowledge with us and your advocacy on this issue. Any other questions for Representative Jacobson?
No.
Senator Miller.
Thank you. Thank you. And good morning, Representative Jacobson.
Good morning.
So, question. So this committee worked very hard to try to create some transparency and protection for the borrowers of the commercial financing. Would you say what we've implemented is working or not working?
I would say that it is working, but not in the way that this committee might have designed. It is better than nothing, Senator. But unfortunately, as drafted, it's not doing nearly enough that I think that perhaps this committee originally had intended. For example, the limitation on no APR, something that this committee considered and discussed at length, something that the commissioner, the banking commissioner, advocated for previously, was omitted, with my understanding that it would be revisited. In the interim, my understanding, and I believe that testimony later today will corroborate that, MCA lenders have gone to other states' legislatures around the country, urging them to adopt what they characterize as the Connecticut model. So while I believe it was the intention to begin regulating this industry, and to continue to take steps in furtherance of that to ensure that there would be a mitigated risk of bad actors taking advantage and capitalizing off of our system. I fear that those lenders have instead taken advantage of our current landscape, what they characterize as ambiguity in our law, and the lack of regulatory oversight to justify their practices, to say that, aha, because Connecticut has passed this language as is, and has allowed us to ostensibly or in theory act this way, we've done it with their blessing. In other words, Connecticut completely approves this conduct, and all other states should adopt this. The real problem here, Senator, is that flies in the face of what I believe this committee stands for, and I think it flies in the face of what we're seeing other states, particularly New York, doing when they look under the hood of these agreements and see just how these things are enforced. It's no wonder that we're seeing such an influx here in Connecticut. There's no wonder why the superior courts of our state, particularly Stamford, which borders New York, is being completely backlogged by what is in essence a flight from New York, where there's a crackdown on this industry, into the state of Connecticut, where the regulation that's at least compared to New York are lax at best. I believe a change is necessary in order to address that influx and to address what we're seeing firsthand in terms of how these actors are taking advantage of our current statutory safeguards in order to, in essence, pump up their profit margins.
Thank you. And the legislative intent was not to give our stamp of approval to the industry. You're right in that this committee worked very hard in trying to protect the consumer. And at the time when we had implemented the policies, I guess it was New York and California at the time were having issues. And so I personally want to see how it played out. And we knew that we would have to revisit this because like some laws, when there are bad actors, they find a way to get around whatever legislations or laws that are in place. And so they look for loopholes. So as my co-chair stated, thank you for bringing this to our attention. And it really does help me to have a practitioner in the General Assembly where we could actually, who's experienced the industry, the predatory, I guess the predatory, right. What's the word I'm looking for? And I want to be gentle about it. Taking advantage, they're predators, okay? And so, and I've always felt that way, but as chairs, we have to try to feel, come to a balance, an agreement, a consensus of what works. And so I think that to hear that we're being used as the Connecticut model by the industry is discerning to me. And again, I thank you for bringing this to our attention and willing to work with this committee on trying to create more transparency and fairness. So again, thank you. And thank you, Mr. Chair.
Thank you, Senator.
Thank you, Madam Chair. Any other questions for Rep. Jacobson? Seeing none. Thank you, Representative Jacobson.
Thank you, Mr. Chairman.
All right, next we're going to go to Connecticut Bankers Association, presented by Mr. Mangello and Attorney Corey. All right, okay, good to know. Good morning.
Thank you, Art. Chair Doucette, Chair Miller, ranking members Berthel and Hoxa, members of the committee, Representative Delnicki, great to see you back in the building. And thanks for letting us be here today. It's great to be here for the first official public hearing of the Banks Committee for 2026. We did submit all our testimony over to the committee earlier this morning. You should have it all online, but we're just going to cover briefly a few of the things that we have positions on, and we'll try to be brief. With that said, I'm going to cover probably 3 bills relatively quick, and Art is also going to do another 3 bills. Happy to answer any questions that the committee members may have. With that said, first up is basically what I call an escheat bill, and that is the first on the agenda, Senate Bill 215. And this would basically expand the ability of banks, not expand, it would permit banks to essentially, instead of having to automatically escheat an account if it were abandoned, if any other account activity was there within the bank on the depository side of the equation, whether it be a savings account, a checking account, a CD, and those were active, we would not have to essentially escheat the other account. So a perfect example is if I have a savings account that has been inactive for 3 years, current law says, I have to turn that over to the Treasurer's Department by the subsequent year, March 31st. This would allow us to say, okay, while that's been dormant, while the savings account has been dormant, the checking account is active or a CD is active, or another type of an account like an IRA. So if there's any other depository relationship with the bank, that would basically suffice to say that these accounts are not dormant. That would allow us to not be mandated to have to turn those dollars over. I think many representatives and senators around the building here have gotten calls from constituents saying, what happened to my money? We certainly get it all the time. So this would eliminate a lot of that, as it should, because if you've got an active relationship with a bank, you know that person is there. However, state law requires us to essentially turn anything over after 3 years. Safe deposit boxes, by the way, are 5 years, and that would be a similar type of a situation that we would be looking for. Additionally, what we're suggesting is because we know customers, if they're actively involved with our bank, is expanding this over to lending relationships. If we have a mortgage relationship, a commercial loan relationship with that customer, we know they're there. We know they're active. They're still doing things. And all because they're not actively doing things with a particular account, that doesn't mean that, well, for us, that means that it should basically be not escheated to the state of Connecticut. So this is a great idea. While it's not ours, we're fully in support of it and happy to answer any questions on it.
The next bill we'd like to talk about is Senate Bill 16. This is a proposal by the state treasurer to improve the current program under which the treasurer invests in community financial institutions, essentially takes state funds and purchases CDs. We're in support of this wholeheartedly. We look forward to working with the treasurer to on the procedures for this what will be a revised program.
Okay. So next up, there's actually 2 bills. This is number 3 on the agenda, Senate Bill 217 and House Bill 5212. The committee has seen these bills many times. They tend to be a perennial which comes up. Our position has not changed. This would basically require mortgage lenders, banks, credit unions to essentially accept partial payments on the mortgages. When you're talking about community banks, the primary reason that we're opposed to this, when you're talking about community banks or credit unions, or usually mortgage lenders, mortgage bankers in the state, the processes that we use, the systems that we use are provided by third-party providers. Those third-party providers that put together our mortgage servicing platforms, they basically do it on a nationwide basis, usually with all the requirements and the rules that are associated with the secondary market, whether it's Fannie Mae, Freddie Mac, Ginnie Mae, or FHFA. So that's basically the standardization that's out there. So community banks, credit unions, we don't have the ability to control that. So we have to go out and we actually purchase that system from a third-party vendor out there. So for this bill to essentially make us do it means that we would have to go to the third-party vendor, try to get them to essentially respond to us. I can tell quite frankly that there's a lot of third-party vendors that are huge, and they would basically, if it's community banks in the state of Connecticut, they're probably just going to say, well, that's nice, but we'll just stop doing business in the state of Connecticut, especially if it's a smaller volume that goes on out there. So this would be a big, in our opinion, problem for the community banks and for the credit unions as well out there. Both these bills basically hit at the same target, if you will, trying to essentially create flexibility. We totally understand what the proponents want to do with it. However, it's kind of unattainable for the smaller institutions here in the state of Connecticut.
House Bill 5210, the department's bill on data breaches. We look forward to working with the department on this. We'd like to see some of the language modified slightly to more align with federal guidance and regulations on notifying regulators regarding data breaches, and also with the department's current guidance on notifying. And then the last bill is on shared appreciation agreements, just a clarification to ensure that that's a non-bank statute over in the licensing statutes. We just want the language to be consistently applied to licensed providers, licensed mortgage lenders, which banks are not. Banks are regulated, under their charter.
And be happy to take any questions.
Okay, thank you. Questions for the gentleman? I'm going to go to Senator Miller.
Thank you, Mr. Chair. Hello, Art and Tom. Thank you for joining us today. So I have a question. So in Senate Bill 217, can you explain again why that can't be done?
Sure, Senator, and thanks for the question. So once again, we have smaller institutions out there. When I say smaller institutions, we're really talking about the state chartered institutions. They don't have the wherewithal to essentially put together an exhaustive system of mortgage servicing internally. They have to rely on third parties that are out there producing national programs out there based on national standards. So when things change on a local state basis, those institutions have to go to their providers and ask them to make those changes at significant cost. The vendors are not going to do it just because they're good people and they're trying to do the right thing for all the people that are all the banks and entities that are doing business in the state of Connecticut. They're going to charge, and it's going to be significant, especially because they would have to retool their existing mortgage servicing platform. After they retool that platform, they would not be able to essentially use it as is throughout the rest of the state. So it would create quite a bit of customization that would have to take place. Additionally, well, I should ask you, Senator, did that answer your question?
Yes. You said additionally, I thought there was, you would say, Tom, so question. So let's look at this piece then as an education piece of policy, all right? Will banks be able, and small community banks, be able to educate the lender on their options of what the their schedule would be, their payment schedule, or the equity would be? Should they pay monthly, bi-monthly, or semi-monthly?
So I believe that is included in all the disclosures. I think those folks who have gotten a mortgage before know that there are exhausted foreclosures. But there's also a very simple cover page, if you will, which really covers all the main details when you get a mortgage, whether it's a monthly mortgage, a biweekly mortgage. It clearly details essentially what that payment cycle is supposed to be, and obviously what the amount is going to be, except for an adjustable rate mortgage, which may change on an annual basis. So those disclosures are there right from the get-go as you're basically executing the mortgage and getting the loan proceeds.
Right, but what I'm saying something different. I'm talking about giving the lender the option of paying if they want to, just to inform them, this is your this is how long it would take you to pay your mortgage off if you pay monthly, if you pay biweekly, or if you pay semi-monthly. And so it's just like the credit cards that we have, that we get that statement, and it tells you how much interest you would pay. And if you don't pay, if you're paying the principal, you're paying the interest, or whatever the case may be. I'm talking about that because I realize that the sooner you pay off your mortgage, the more equity you have, right? And so, and that's what this legislation is trying to get at, is to allow the borrower to receive their equity sooner. And so some people don't know that you can pay your mortgage off. You could pay extra in your mortgage. And so I'm just saying, can there be a tool? Can there be a document with the mortgage that says this is your monthly mortgage? And we know it gives you that if it's paid monthly and whatever the case may be. but say these are your other options if you decide to pay extra. If you decide to pay it bi-weekly, semi-monthly, or if you decide to pay it bi-weekly.
Yeah, so I think I understand what you're saying. And I think the issue that comes up is that with regards to the payment cycles, a lot of those cycles are dictated by contractual arrangements, particularly if you're selling those loans to either private investors or Fannie or Freddie. The contract indicates what the period is supposed to be that you're supposed to pay that mortgage on. I agree with you that it's a good idea to essentially have that educational process to let borrowers, homeowners know that you can easily add to the principal on your scheduled payment, either on a monthly basis, or if it's a biweekly mortgage, you could do that on a biweekly basis. There's obviously nothing to prevent people from doing it, but I understand what you're saying, Senator, is that, education is key, especially on the financial side of the equation, to give people those options to do that. But contractually, most institutions and mortgage servicers out there are obligated by a contract as to how they essentially need to intake the payments that the borrower is making.
Okay, so, all right, I understand that. And I guess I'm getting at, Tom, when I got my mortgage, the bank, no one told me anything about paying off my mortgage earlier. It was something that I read and I said, oh, so I ended up saving 3 years on my mortgage by paying an extra $100 a month, right? And what I'm saying, if we could educate individuals at some point, and the point of entry is the bank when they get their mortgage, that even if you just say, there's something to say that if you pay your mortgage, pay extra towards your mortgage, that your payment would be, your mortgage be before the 30 years or whatever the term is. And so I understand that banks lose money, right? That you lose money when people pay off their mortgage earlier. So, and I get that, but I just think that the consumer is just a way of educating the consumer, because especially when you're a first-time home buyer, I'm dealing with someone now and she just didn't realize the intricacies of purchasing a home. And people don't know that you can tap into your equity sooner if you pay your mortgage, your mortgage off sooner. And so just paying on the principal. So that's all I was interested in, Tom. And that's what this bill is trying to get at. New Jersey it's currently law in New Jersey, by the way. So, but that's what I was getting at, just so that people have access to the equity in their home sooner than 30 years or whatever the terms of the contract is.
Yeah, thank you for that, Senator. And we can certainly look at that educational piece of it, review the disclosures that do get handed out to people as they're about to enter into a mortgage agreement.
All
Thank you.
right, thank you. Thank you,
you.
Tom, and thank you, Mr. Chair.
Senator Berthel?
Thank you, Mr. Chair. Tom, Art, good to see you as always. Thank you for your testimony today. So just to kind of piggyback on some of the comments that the Senate co-chair made, all of this is disclosed at the time that the consumer is signing the mortgage agreement in terms of the repayment process and what is accepted as a payment, correct? It says there you must make a payment in full on this frequency by this date, whatever it is. Is that
Yeah,
correct?
It's clearly detailed and also probably buried in that monumental.
Yeah, in the
document
big,
everybody has to
thankfully,
sign.
a lot of it's electronic now and what have you. So let me ask you a question then. If it's one of these institutions that are state chartered that fit within the category that you described, where they're perhaps relying on a third party servicer, whatever it is, or it gets sold to any one of the places where a mortgage could be sold to, what happens if I make a partial payment?
It depends on whether or not the institution will accept it. And if
Okay.
the institution accepts it, it would have to essentially be able to fit into that mortgage system. Quite frankly, the systems that those community banks and credit unions I was talking about, they don't allow for that. And that's probably because 70% of the mortgages that get originated wind up getting sold to that secondary market that I mentioned before. There's a number of mortgages which will be put into portfolio.
Mhm.
So let's say that's around, 30 or 40%, depending on the bank or the credit union. So for those particular ones where you've got like internal servicing, which is that is a possibility. So it really is just a call your bank as
Right,
to see
okay.
whether or not you would be able to get that done. However, once the loan is sold and you're servicing it for an investor, which could be Fannie or Freddie or
Yeah.
whoever, or a private investor, then you're locked into that contract and you have to abide by contractual law.
Okay, and I guess the same logic would apply to an additional payment as well. There's a lot
Yeah.
of, there's still very much so out in the internet space, make that 13th payment and you'll cut your mortgage and your interest paid substantially. But I guess
Could I just add real quick on
of
that?
course,
So I don't believe, and Art, correct me if I'm wrong, that there's anything which precludes you from adding to principal payments if you're doing it during your normal periodic payment. I don't
Okay.
think there's anything which prevents you from essentially doing more, unless, of course, you maybe have an early loan payoff would be a different scenario.
Yeah, and many servicers actually facilitate additional principal payments through their website or through other ways. So it is as long as you made your full monthly payment, you can always make an additional payment. So the
You
partial
can
payment.
add to escrow, you can add to principal. So
Okay.
there's always options which are available there.
right. So I guess that kind of takes me full circle. Then why do we need the bill, right? If we can already do that, even though you've expressed very clearly that that the systems that the banks, the financial institution or the portfolio owner, whoever it is, may not have the ability to process just a partial payment. I think that I'm trying to think of the mortgages I've had over time where you and they've been with a small state chartered and with big, secondary market stuff, where you can in fact increase payments for principal and what have you. So that's an interesting dilemma, I guess. And then I guess the only other thing that has come up in the past with this legislation is that we have also had some discussion about late payments, partial late payments that were embedded in former versions of this bill in prior years. And I think it's not part of this, so maybe it's not worth continuing the dialogue. There's another bill for that as well. The House bill is the same thing, isn't it?
5212. No.
It's
Okay, so 5212. Yeah, and that seems to me that that the institution should be, I guess, if the consumer is acting in good faith, to try and get caught up and not end up in the beginning of that foreclosure process, which we know we've spent a lot of time here over the many years I've been on this committee to fine tune that foreclosure process for the consumer and get them into the state program for avoiding that and all of that, right? But I also understand that there is a document you sign when you take a mortgage that says if you're late, right? And the bank can report you as late and all of that. So there wasn't a question in that. I guess I'm just making statements out loud, but all right, I may want to have a conversation with you outside of this meeting about 217 and 5212 as well, because I'm sure I'll think of some other questions. But Mr. Chairman, thank you. Thank you for being here again and providing some insight. Thank you.
Senator.
Thank you. I did have a couple questions as well, and we talked a lot about it, but I just want to flesh it out just a little more on the 217 concept, the additional payments made on a mortgage loan. So you will admit that, and I guess we can't say, maybe it wouldn't apply. I'm going to think about how I say this, to 100% of the mortgage loans that your membership makes. But if not 100%, then maybe 99.9% of the loans that your membership makes, they will accept additional monthly payments, correct?
If you're talking about portfolio loans that.
No, I'm any loan, a prepayment, a prepayment, so long as the loan is current, an additional prepayment of principal.
As long as it's in the cycle, as long as it's within the agreed upon payment cycle. So first of the month, that's when your payment is due. you can essentially add anything you would like with regards to if you want to prepay principal, if you want to prepay
Yeah.
escrow accounts.
But I think you could pay in the middle of the month too. If you came into some money, you got a bonus at work, you say, I'm throwing this on my mortgage.
You
The
could
the
pay
bank is
early,
never going to refuse that.
as
and
long
the
as
only
it's,
reason
as
I
long as
say
it's
that
a
it-
full payment.
It,
Because
no,
otherwise.
no, no,
then
no.
it's-
Right. So I made my payment at the beginning of the month. And then in addition to that, on the 15th of the month, I get a bonus at work. I'm going to throw this on my mortgage. The bank is never going to refuse that. They're always going to accept that, correct?
It depends on the particular mortgage and what the contractual situation is.
So, I mean, my
They may-
experience is that there are, again, that's why I said a 0.01% maybe, in the residential market, will have a prepayment penalty. But the vast majority, the 99.999% will say you can make any voluntary prepayment at any time, under any conditions, on any date, what have you. So I guess my point is that, you know, a lot of time we do legislate things that are accepted practice or are, you know, impliedly legal already. But we sort of put it into statute to clarify it and reaffirm it. It seems to me that this is one of those instances where the practice itself, there's no issue with it. It's part of accepted practice already. But to state it in legislation, I understand, maybe it's one of those things that goes without saying. So why do we need to say it? But what's the harm in saying it? I mean, we go through these things all the time up here. So I guess my question would be, like, looking at the language that's in here, it says, mortgagee shall accept a payment. Is there any other variation of that you'd be comfortable with? Even possibly including a mortgagee may accept payment. I mean, is there any harm in that?
Well, we can definitely bring it back to our membership and see what they say about that and get back to the committee. But thank you for the suggestion.
Okay, I just wanted to throw that one out there. I had a couple other questions. On the sheets, which is SB 215. I don't know if you've seen yet, but the treasurer submitted written testimony. He's not joining us today, but he did submit written testimony in opposition. And I guess the first question is, have you spoken to their office or do you plan to? Certainly would appreciate.
Yeah,
some
Art did
dialogue
talk.
there.
Art did talk with the treasurer's office.
Yes, the treasurer's office reached out and asked us why we had submitted the bill without letting them know. And I said, I thought you submitted the bill without letting us know.
Yeah.
And we found out together that it was
Well,
not either of us.
They actually said that to us as well. So don't feel bad about that.
We're aware of the treasurer's testimony, and I think in that testimony they indicated that in GAE they've got a bill to expand the incidences of contact with a customer that would count toward stopping the clock, the sheet clock, from running. So we indicated to the treasurer's office that we'd be happy to work with them on both of these bills. We happen to like this one. Seems pretty logical that if you have an active account over here, you wouldn't have an account over here, get escheated to the state and have to go through that whole process. So we're in conversation with the treasurer's
I think
office.
so too. I do want to highlight one thing they said in their written testimony. They said that the proposed approach here risks creating unintended negative consequences. For example, it could result in an inactive account accruing service charges for considerably longer than it would under the current rules. I'm not sure I quite understand or share that concern. Do you have any thoughts on that?
I
criticism?
think they're referring to inactive account fees, which I don't really see. We'd have to do poll our members on that. I did see that this morning too, but I don't hear much about inactive account fees anymore. But where they're fully disclosed to the customer, and our banks are typically reaching out to these customers that are experiencing these ongoing fees, saying, hey, you ought to try to avoid that.
And if there were any fees that were being charged on the particular account, then it would be disclosed on a monthly basis through the statement process, whether that be electronically or in paper.
Right.
The other thing I would mention, if it's okay with you folks, is that we do an exhaustive amount of work on the ESG process for the treasurer's office, exhaustive. We actually have to do safe deposit box auctions on an annual basis, advertise it out 2 weeks ahead of the auction. We have to do it around the state of Connecticut. We ESG virtually, hundreds, well, I'm not sure of the exact dollars amount, but let's just say millions of dollars to the treasurer's office on an annual basis. We don't get remunerated for that whatsoever. We're doing this because it's what the statute tells us to do it. So we're really good corporate partners in the ESG process. This would make it a lot easier, in our opinion, and it would also eliminate a lot of the unhappy customers that come to us and say, "What happened to my account?" If you've already got another active account that obviously the bank knows exist.
Yep, understood. Okay, and finally, just one question on the 5210, the data security. You indicated that you're willing to work with DOB on refining the language. I'm just curious what, and you made a reference to the 3 business days. It looks like that, the way it's drafted is pretty pro forma with the references to the federal law. I guess at the end of it, where it talks about the 3 business days and the circumstances under which you'd have to submit that information, that's where there's perhaps some, tweaking that may be done. Do you have any suggestions now as to how we would do that?
Yeah, I think the time period, the 3 business days is short, but it's sort of when the clock starts that really matters. It's when you know or have reason to know that there's been an unauthorized access to information. And I've personally been involved with banks and these data breaches, and I understand that there is sometimes a service or a third party that's involved where the information has been accessed, and it can take more than 3 business days to figure out whether anything actually was obtained in an unauthorized way, whether customer data was obtained. So it can take much longer than 3 business days. So it's that language. It's also the 3 business days. There is federal guidance on this as to when the clock starts, what kind of breaches get reported to the federal regulators. We think that works pretty well. It's been around for a long time, that guidance, and we think that we could work with the department just to shape this and give a little more flexibility on the reporting and also in line with their current guidance, the department's current guidance.
Okay, sounds good. Yeah, I would like to see you guys get together on that. Okay, any other questions? Delnicki?
Thank you, Chairman. Did you touch upon 5209 at all? I know you had a narrative in there on it.
Yeah, that's the shared appreciation agreement, Bill. Those shared appreciation agreements are regulated over in call them the licensee statutes, the creditors, the non-bank creditor statutes. And there's a reason those exist, because before those statutes were there, those industries weren't regulated. So that's a product that's regulated over there. The banks are already regulated under their charter and the banking laws, all of the consumer protection laws, mortgage laws, and regulations, as well as unfair, deceptive, abusive acts and practices laws. So we would just like to make sure that those statutes, don't implicate us accidentally, I guess, is really what this would be.
And you were looking for the term licensed mortgage lender?
Right. The definition of mortgage lender could include banks. So throughout, including the current shared appreciation law, the term licensed mortgage lender is used to differentiate the fact that these are not banks. These are other types of non-bank entities.
Because I know we've had a lot of discussions about the concept and requirements on the shared appreciation product and whether or not it should be considered a mortgage product or not. Your input on that?
Well, I think one thing that I'd like to point out is that, as Art said, we're trying to keep a very clear line between the Division of Financial Institutions at the Department of Banking, which is our prudential regulator, and we've got exhaustive regulations and you name it, examinations that happen on a regular basis, and the Consumer Credit Division. The Consumer Credit Division, as I think the committee knows, basically regulates a host of different entities that would take me 5 minutes for myself or Matt to go through about all the entities that they regulate, right? Some of which previously were unregulated. So we don't really want to be in that department. It's not the financial institutions division department. We want to be totally separate from that in, the appropriate division of the Department of Banking where it resides. But we really don't have an opinion on the shared appreciation product because our banks don't offer them. And, that's kind
Yeah,
of.
and I brought that up because I know you guys typically have tried to stay away from that nomenclature and that product. And when I saw it in there, I'm saying to myself, gee, that's a change of pace there on the direction you're going in. Thank
Yep.
you, Mr. Chair.
Thank you.
Representative? Okay, seeing no other hands. Thank you, gentlemen,
Thank you.
as always.
Thank you.
Okay, next on our list is Jared Alphen. Afternoon.
Good afternoon, chairpersons and members of the committee. My name is Jared Alphen. I'm an attorney practicing in Connecticut, representing commercial businesses and financing companies that provide working capital to small businesses throughout the state. Feels like almost yesterday where I was here, again, talking about the same bill, which seems to be of interest. So I'm here today to talk about it, and I'll try to be brief because I would like to take some time just to field some questions. I respectfully oppose raise bill number 5211 because while well-intentioned, it will significantly restrict access to capital for Connecticut small businesses, create practical impossibilities in commercial financing, and it raises seriously constitutional questions. The merchant cash advance contract itself is a recognized form of financing. It's not a loan, which is very important for the members to understand. New York law recognizes a distinction between a loan and an MCA. Despite that there are bad actors, and there are bad actors in every industry, it's still recognized form of finance. I'm going to touch upon two parts of the bill. One is the 7-day waiting period, which I believe is just practically not really workable. Merchant cash advances exist for really one reason, for speed. Merchants need the advances quickly. They're facing payroll emergencies, inventory shortages, tax obligations, or immediate operation disruption problem solving. In essence, the merchants are coming to these funders looking to get funding within 24 to 48 hours. Once these contracts are signed, the funds are almost immediately dispersed. A mandatory 7-day delay fundamentally defeats the purpose of why people are coming to get this type of money. They're coming for it quickly. They're not going to be able to practically wait 7 days. If that's the intention of the bill, I just don't see this as a practical solution. What's going to happen is merchants aren't going to wait 7 days. They're simply going to seek funding somewhere else. They're going to go to out-of-state providers. And again, Connecticut then loses business for funding companies in Connecticut who pay taxes. They pay corporate fees. They utilize the court system and they pay thousands and thousands of dollars in fees. And there's other things that go along with that. Marshals are receiving payments. There's a lot of business that these funding companies give to the courts and the state of Connecticut as a whole. If the bill's intention was essentially to allow the merchants to cancel the transaction up to 7 days after funding, then what happens is these merchant cash advance agreements sort of turn into bridge loans, where a merchant cash advance merchant will come and say, I need an advance, and they'll get it for a few days, and then they'll just give it back when other funding arrives, which is totally not the intended purpose here. I don't think that's what it is, but I just wanted to be clear that it's not a cancellation and paying back the money, because that's a recipe for disaster. So the bill doesn't really protect the merchants. It really just pushes capital out of the state of Connecticut, which is not what we want with this 7-day waiting period. I also want to talk about quickly the ex parte prejudgment remedy, which will have a chilling factor in Connecticut. This bill essentially—
Your 3 minutes are up. Please wrap up your remarks.
Sure, thank you. The prejudgment remedy is going to essentially dissuade merchants, funding companies in Connecticut to want to give out the funds to these smaller companies. There's going to be no security. There's going to be very little ability for them to essentially recoup money when the merchants themselves are there to take the money and never pay it back. There are due process and procedural safeguards built into the PJR statute that essentially allow this to happen. We're not in a situation where I heard one of the speakers here today call it the golden age of piracy. You would think that there would have been an AG investigation, there'd be AG lawsuits, there would be merchants lined up around the corner complaining about this. I'm in this business and I haven't heard a single one. I haven't heard a situation where the merchants are upset. There aren't complaints that are being filed at the AG's office or Department of Consumer Protection. I haven't seen any. The MCA industry is, in Connecticut at least, is dealt with by lawyers who I believe are responsible. They appreciate regulation. I appreciate regulation, but at the same time, I think that it's by targeting out one type of classified alternative financing product and terminating the PJR for that one specific industry essentially is targeting, and it's unconstitutional. And again, why a bank that gives out $10,000 to a merchant and the MCA gives the same amount of money to the same business, why is the bank allowed for the PJR to happen, but the MCA is not? It doesn't make any rational basis. Although it hasn't been challenged, I suspect if we continue to go down this route where the MCA regulations come to a point where they're now just touching upon constitutional and rights that are now being infringed upon, I suspect there'll be some backlash. But again, the MCA funders, the lawyers that represent them, are responsible, and I haven't seen and I haven't heard of any type of stuff that Attorney Jacobson talked about in New York. It's not happening in Connecticut because we're responsible lawyers, and I think the statute should remain unchanged.
Okay, thank you. Thank you. Any questions? Any questions? Seeing none, thank you for joining us today. Okay, next on my list is Gerlinda McGinn, who I believe is online. I see is in the, okay, Gerlinda is in the Zoom room, but needs to accept the panelist link. Okay, so I'm going to skip for now, but if you can hear me, you will need to click the link in your Zoom in order to actually join us as a panelist. Okay, so we're going to skip for now. Number 6 on the list, Christopher Selke, who I don't see on the list of attendees. No, okay, Christopher Selke's not here. Gerlinda has raised her hand.
Gerlinda, please accept the panelist promotion so I can let you speak.
Next after Gerlinda is Eric Verona. Eric Verona with us. Eric was signed up to be remote, but I don't see his name in here.
I'm here.
Oh, there he is. Okay, great. Thanks, Eric. Please proceed.
Okay.
We can hear you, but we cannot see you.
How do you get to see me?
That's not,
Oh, here we go. I got it.
okay.
Hello, everyone.
There you are. Thank you, sir. Thanks for joining us. Please proceed.
Thank you for allowing me. My name is, hello, members of the Banking Committee. My name is Eric Verona, and I'm a homeowner in Windsor Locks, Connecticut. I'm here to express my personal and enthusiastic opposition to House Bill 5209. After much research, I discovered HEIs, otherwise known as home equity investments. Other financial options were not a good fit for me because other help was not available due to me not making enough money given my limited disability income in order to meet programming underwriting guidelines. What stood out to me about the HEI was that it will allow me to save my home as well as making updates and improvements to my home without requiring monthly payments that I simply cannot afford. All this for only a limited shared portion of my potential eventual gain in equity. and I'm willing to take that. It's a good trade for me. I haven't completed funding in my HEI program as of yet, but having access to this option has already given me hope to not lose my house that I have been in right now for 21 years. Homeowners in Connecticut need options like the HEI because it is a unique product that can help people save and stay in their homes who may otherwise lose them. I want to thank you for taking the time to consider my perspective. Please help ensure families in Connecticut can continue to access home equity investments as a flexible financial alternative. Thank you.
Thank you, Eric. Appreciate you joining us and your perspective today. You know, we often hear when we're proposing these bills from industry, we hear from, you know, advocacy organizations, and, you know, more seldom we hear from actual consumers who are affected by these things. So it's good. I appreciate that you joined us today. How did you hear about this?
The company that I'm involved with and have applied to has made me aware that this legislation, or this bill, excuse me, was being considered, and I was wanting to have the opportunity to tell you about my experience and the fact that this is literally going to save me in exchange for what I consider to be a reasonable cost and it's even a potential cost in order to save my house, because I've been literally working on this for a month, looking at HELOCs and refinancing and all that. I'm a disabled veteran. I make a very limited income, and I just simply don't qualify for things like that.
Okay. Yeah, that was going to be my next question. So, you know, I understand if you look at a HELOC, they're going to look at, you know, your income and assets and so forth. And so it sounds like that was not an option. Any other options like reverse mortgage? Was that something you are, I don't know how old a guy you are, but if that's something that you were eligible for or looked at, or any other options that you sort of exhausted in coming to this?
Well, I've looked at the other options that I mentioned, being the HELOC and the refinance with cash out, and my loan to income is too high, and my utilization of credit cards has been too high, even though I'm trying to wrap that all up into getting things the burden off my shoulders and getting it rewritten in the process of this. But I've also looked into reverse mortgages, which, as you know, has their own set of circumstances that make them a little bit risky potentially. But I am not 62, but in Connecticut, there are plans for people such as myself who are over 55. I am 60. So there is that possibility, and I have considered and am also considering one of those. But I don't even qualify for all of those. I have looked at all those because not everyone will go down to age 55. And the ones that will, they still need to get a certain equity to, you know, what you owe versus what it's worth ratio, so that they can provide me the cash out that I need to pay off my town for the money I'm in arrears to, and to prevent a tax auction in April.
Gotcha. Okay. And then my last question was, if you don't mind sharing, just curious again to get a perspective on the product and the market. What, how much equity do you have? What is the estimated value of your property? What's the current debt? What would you buy it for? Give us a picture of that, just so we can, again, understand, you know, what, how this option works for someone like you.
Absolutely. I'm really happy you're asking me these questions. It shows that you're interested, and I think it allows me to give you a good feeling of how hard it is for me as a disabled veteran on a limited income to make things work in a more traditional manner. I have significant equity, having lived here for 21 years and having bought in a market that was, you know, 21 years ago. So I currently have a payoff letter from my bank of $178,000. And I have a home that is now appraising online, at least. I'm getting an appraisal done officially, but the appraisal I'm getting is in the low to mid 500s. So there's plenty of equity.
Quite a bit.
And I'm looking at losing my house over $16,000 in tax debt otherwise.
Right. Okay, so the taxes, so, and the last question, again, just to get a picture of, you know, what your options look like. What's your current interest rate on your current mortgage? First mortgage?
4.74.
Okay. So that's pretty good.
It
So
is.
You'd
And I don't lose that using this program.
yeah, right. But you said, again, that the tax debt is a motivator, big motivator.
It's the necessitator.
Yep, yep, okay. All right, well, again, I really appreciate you sharing your situation. Any other questions for Eric while we got him? Seeing none, thank you, sir. You have a good day.
Thank you for allowing me to speak, and I wish you all the best.
Sure thing. Okay,
We on video.
do we have, we have Gerlinda in the room now.
Okay. Hi, sorry about the technology glitch.
Okay, great, but you were with us. We can see you and hear you, so thanks for joining us. Please proceed.
Yes, well, I'm a consumer and I live in Pawcatuck, Connecticut, and we decided to try the home equity investment with Point after trying to get a HELOC, which was impossible at the time. And also, we went to a credit union, but they just laughed at us. So Point was really the answer for us. And we experienced a catastrophe in our home. An oil delivery truck drove over our leach field and caused $30,000 worth of damage. And our home insurance would not pay for it. So we were stuck between a rock and a hard place. And, you know, we were, the HEI was really a lifesaver for us. And I just, you know, we found that the stipulations that they had really worked for us, and we were able to save our home.
Okay, thank you. Thank you for sharing your story. I don't know if you heard our conversation with the last gentleman, Eric, but again, as I said to him, I do appreciate hearing from you. We like hearing from consumers and the people actually in the marketplace who are affected by the things that we're discussing and proposing. So I'm assuming you also heard from the company you said Point that you're currently working with that there was a legislation being proposed. Is that correct?
Yes, yes.
Okay. So question that I did not ask for Eric, but I'll ask you, is there anything in the bill that, as you've heard about it, that, you know, you think would cause a problem for this product or for consumers like you? Because, you know, what's in here, you know, is a lot of additional disclosures and things that are designed to really protect the consumer and inform the consumer. But have you heard anything differently about it?
No, I haven't heard anything differently, but the place where we were stuck was we had a lot of illness in the family, and so our resources were depleted, and our credit card score was below 600. And Point allows you to have a credit score of 500 to 600, and they will fund the home equity investment. And that was the point that really made a difference for us.
Yep. No, and I appreciate that, and I agree with you. And frankly, from where I sit, we do want to have, you know, options for people like you, but again, the point of the legislation is to add, additional protections for consumers and additional disclosure so that everyone is well informed of how these products work, because they're a little unusual and the market's sort of emerging now a little more. So that's all. Well, thank you for joining us. And I know you guys got hit pretty hard down there. Did you get 30 inches of snow? Is that accurate?
About 30 inches, yes, and we've been digging out yesterday and today.
All right. Well, good luck. Any other
Thank you.
for Galinda? Actually, Representative Delnicki has a question for you.
Yeah, just a quick comment. It's refreshing to hear from the people and to hear about some of the products that we're involved with and the positive results that both of you folks actually are getting from that.
Yeah,
So
we're very grateful.
Great. Thank you. Okay, Galinda, I'm going to let you go. I appreciate you joining us today. All right. Next on my list, I have John McCrae, who I'm not sure, is John online with us? No, he disappeared. Okay, so maybe he'll come back. That's okay. After John, I have James Downey. Is James with us? No, James is not here currently. After that, we have Diana Koch, who is online, I believe. Hi,
Hello,
Diana.
how are you?
Hi. Good to see you. Thank you for joining us. Please proceed.
Thank you so much. So this is my second year testifying here today. I was here last year also advocating for the stay of the PJR and to lower the threshold to the $100,000. And today I'm here on behalf of my MCA company that provides working capital to small businesses, including merchants right here in our state. I appreciate the chance to share what this bill would look like from the perspective of a company that's actually funding these deals every single day. The reality is that most of these businesses who come to us are not seeking long-term financing or expansion capital. They're not planning new locations or major investments. They're trying to solve immediate real-world problems. And this is like making payroll on Fridays, purchasing inventory, covering a seasonal slowdown, or handling an unexpected repair or expense. In these situations, timing isn't just important, it's very critical. When a merchant reaches out to us, it's usually because they need funds quickly. And once an agreement is signed, funding typically follows immediately. If a mandatory 7-day waiting period is imposed, many of these transactions would simply not happen in practice. The businesses we serve often cannot afford to wait that long, especially if they're looking for the funds to cover something immediately. As a result, they might be forced to look for funding elsewhere outside of Connecticut, or they might not even be able to get funding at all. With respect to the proposed elimination of the ex parte prejudgment remedy, it's important to clarify these remedies function as risk management tools rather than punitive measures. In commercial transactions like ours, where assets and receivables may be rapidly transferred or dissipated, these remedies provide a measure of predictability and enforceability. The removal of such protections would materially increase the risk profile associated with the providing funding. As risk increases, capital providers necessarily adjust by tightening underwriting standards like ours or increasing prices to account for heightened exposure. The economic impact of those adjustments ultimately fall upon small business merchants in the form of reduced eligibility or higher costs. Another concern is that this bill applies specifically to only one type of commercial financing, while the other commercial agreements, such as leases or traditional business loans, are treated differently. From our perspective, these are all business-to-business transactions entered into by commercial entities. It's difficult to understand why one category is being singled out for different treatment. We fully support clear rules, transparency, and fair dealings in the merchant cash advance space, and we believe in responsible funding and protecting small businesses. But changes that slow down access to capital and remove basic enforcement tools are likely to reduce options for Connecticut businesses rather than protect them. Thank you for your time.
Yeah, thank you, Diana. Any questions for Diana? Seeing none. thank you for joining us today. Okay, next on the list is Vincent Sabano, who I believe is online with us. Mr. Sabano, you are up. If you'd like to unmute, and you can turn your camera on if you wish.
There we go. I think you can hear me. I don't think, I'm not sure how I turn the camera on.
I
but-
can hear you. I can't see you. That's not necessarily required but
A positive benefit for you guys.
you can proceed. Okay.
I want to thank the banking committee for allowing me to speak on behalf of my opposition to this new bill. And I have to confess up front that I'm a homeowner from New Fairfield, Connecticut. And I have to confess up front, I'm not 100% sure of all of the particulars of the new bill, or the proposed bill rather. And but I have had a very good experience with Point using this kind of equity thing. I went into an equity participation loan. I searched for it very diligently because, as you probably know, you get 10 if you're looking for mortgage financing. There's no dearth of people calling you offering various types of loans. My particular situation was a little bit like I think it was Eric Verona who spoke earlier, in that I don't, as a retiree, I don't have a great deal of cash flow. I don't have a great deal of income that I can use to pay back any kind of financing that I would have gotten over to support the ongoing costs of my life. Reverse mortgages don't work for me because I have, luckily for me, I have a younger wife, and she's and you know, she would necessarily drive down the amount available for funding under a reverse mortgage. I needed this I needed some sort of financing because of the obviously the high ongoing costs of property taxes, maintenance, and that kind of thing. Also, I needed to have cash flow for various investments and things like that, which I'm conducting on a regular basis. This equity participation really paid off in terms of my goals, because it's not an impingement on ongoing cash flow. It's also not a significant burden on heirs or on my on the house itself, because their payment is in the form of it's really an option to buy the equity of my house, or a portion of the equity of my house, and only that portion of the equity that exceeds the current value of the house. So they're not saying, look, you made a great deal, you know, back 10 years ago when you bought the house. We want to play, you know, we want to play with that. They're only taking the piece from here on forward. So they're becoming, in effect, my partner. The process of getting
3 minutes are up. Please wrap up your remarks.
the process of getting the financing was very easy, and also they required us to go through a good hour and a half of financial financial education, rather, to explain exactly what was going to happen and how it was going to affect it, how it compares to regular mortgages and reverse mortgages. So just in general, I'd just say, if you're looking to add, disclosure to these loans so that people are more informed of this, I think that's great. I mean, I don't think there could be anything wrong with that. But, as to changing the program details and the structure of it, I would be against that. Thank you again for taking my testimony.
Thank you, Vincent. And as I said to the others, we do appreciate hearing from homeowners and actual consumers looking in this market. And again, yeah, the bill that we are considering is adding extra layers of disclosure, primarily. Just want to put that out there, and certainly, appreciate hearing from you, and, we thank you much. Oh, we have a question from, the senator over here. Thank you.
Thank you, Mr. Chair. Mr. Sabano, thank you very much for your testimony. Really appreciate hearing about your positive experience with this product. You mentioned that the company that you're working with has purchased the option from you to buy the equity of your home. Could you explain exactly what the mechanics of that are?
Well, the transaction was structured in such a way that their repayment is equal to a certain percentage of the appreciation of the house from the point that we enter into the transaction, and that amount is we set the initial base period value of the home. And then from that point on, from that amount on, they get a percentage of the total appreciation. So it's in effect, they're giving me a premium on a house to purchase an option. So they're betting that in effect the house is going to go up in value over the next 30 years. That's the length of the transaction. In that time, I don't have to make any kind of payment, but they've given me the money in effect as a way of saying, we want to participate in your equity. So that's their option. I don't know if I've explained that.
Yeah, that's very helpful. And there's no, it's whenever you decide to sell the house, is that how it works, that the repayment happens?
Yes, exactly. If I decide to sell the house, and even if I die, my heirs will, my estate can continue the contract. Contract is for 30 years.
Okay, very helpful. Thank you.
Thank you, Senator Honig. And Vincent, before we let you go, it might be worth it, and as much as you're comfortable sharing, why aren't the more traditional options like a HELOC available to you, or a cash out refi or something like that?
Well, primarily because the income that I report and that I report every year consists of mostly retirement income, which isn't that much. I do earn and report a good deal of investment income, but banks and regular financial institutions, in light of their previous escapades, don't really accept that as being income that you can count on. You know, it's got to be steady for 3 years, as I've been told. That initially was the way I was approaching this, and saying, well, look, I have all this income. And they said, well, yeah, that's all great, except that the only things that we can count on are your annuity payments and your retirement benefits and Social Security. And hopefully, with the way the government is going, the Social Security is going to stay in place. So I wasn't able to qualify for any kind of loan.
Okay, understood. I appreciate you sharing, and appreciate you joining us today.
Thank you.
Thank you. Okay. Next on the list is Lee Kaplan, who is with us online. Afternoon, Lee.
Good afternoon. Thank you, Chairs Doucette and Miller, committee members, for the opportunity to discuss Bill 5209 today. My name is Lee Kaplan. I'm Chief Legal Officer at Unlock Technologies. We're a founding member of the Coalition for Home Equity Partnership, or CHEP. It's a national trade association focused on meaningful, practical regulation to shared appreciation agreements, including meaningful disclosures tailored to the product's actual characteristics. We, along with our coalition members, who you will also hear from today, oppose Bill 5209. We at Unlock have been preparing to enter the Connecticut market this year after receiving our mortgage lending license from the Department of Banking in 2025. If Bill 5209 were adopted as drafted, it would effectively ban shared appreciation agreements in Connecticut, effectively undoing the work this legislature has already done to enable these products to be offered in a safe and responsible manner. For the committee's attention, I want to discuss two specific provisions of the bill. One is the usury question raised in Section 2 of the bill. When the legislature built a regulatory framework for shared appreciation agreements, it had every opportunity to override the Section 37-93 mortgage loan exemption, and it chose not to. That was a deliberate choice. Shared appreciation agreements are mortgage loans under Connecticut law. They involve a defined lump sum advance secured by real property. They fit squarely within the exemption that is applied to bona fide mortgages for decades. The existing framework already imposes disclosure requirements, substantive lending standards, and the Department of Banking oversight. Mortgage loans are among the most heavily regulated financial products in the state. Layering on a usury cap that singles out one mortgage product for restriction this legislature has decided is unnecessary for every other mortgage in Connecticut. It sends a message to originators and investors that this state's views shared appreciation agreements with a level of hostility that is fundamentally at odds with the regulatory approach it's already adopted. Originators have entered this market and structured their underwriting in reliance on settled law, and this provision would upend those expectations without a demonstrated need. Secondly, with respect to the fee cap in Section 2B3, this requires originators to absorb at least half of every third-party cost, whether it be at origination, during servicing, and at satisfaction. That has no parallel in conventional mortgage lending. Connecticut doesn't ask traditional mortgage lenders to pay half the borrower's closing costs, and there is no policy rationale for imposing that requirement simply because the loan takes the form of a shared appreciation agreement. The provision also doesn't distinguish between lender-driven or borrower-driven costs. Let's say a borrower wants to convey title of their property to a living trust that could trigger a third-party fee. The originator would still bear half that cost. Originators will price that uncertainty into potentially less favorable terms for the very borrowers that this bill is trying to protect. Transparency and itemization requirement would achieve the consumer protection objective without distorting the economics of this product. We as an industry have submitted a complete list of comments, and I welcome any additional questions from the committee.
Thank you, Lee. You said you did submit written testimony?
Yes, we did on behalf of the coalition.
Okay, great. Any questions? Any questions? Senator Miller, that's a question.
Thank you, Mr. Chair, and thank you, Lee, for testifying today. Lee, you made the statement that with this bill that Connecticut would ban shared agreements in this state. Can you elaborate on that?
Yeah, so there are a number of provisions that would effectively eliminate shared appreciation agreement providers from doing business in the state, one of which was going to be the imposition of that usury cap that I mentioned. The other one, which one of my colleagues will speak to as well, is a requirement that upon the termination of the term of the agreement, the the originator must be in a position to offer the consumer a mortgage loan at market rate. Most originators are not currently offering those products. That would require the originator to become a conventional loan provider, meaning they would have to become a Fannie Mae, Freddie Mac, Ginnie Mae approved originator. Those bring with it a lot of capital requirements, and that's something that's not currently in any of our business strategies right now. And there are a variety of other reasons that are in the written testimony, and my colleagues will also address.
So we basically wouldn't be banning the product. It was just that the industry wouldn't feel comfortable in doing business here in the state.
Yeah, it would be, that's correct, Senator.
Yeah, okay. Thank you, Mr. Chair. And thank you, Lee, again.
Thank you.
Thank you. Seeing no other questions, appreciate you joining us, Lee, and we'll review the testimony. Just before I let you go, we do have the Coalition for Home Equity Partnership, CHEP. It was under Cliff Andrews.
Yeah, he's our president. That's correct.
Okay, got it. All right, thank you.
Thank you.
Okay, next we're going to go to Andrew Heisor online.
Hello, thank you for the chance to testify today.
Thanks.
Sorry, can you hear me?
Yep, we can hear you great.
Great. I'm a Greenwich resident and a senior attorney at the National Consumer Law Center. We at the center strongly support this bill. Shared appreciation agreements are a new type of first or second mortgage that strips homeowners of their equity. HB 5209 provides critical protections to prevent abuse and preserve homeownership. Connecticut has already become a national leader in protecting homeowners who might be looking at this product by adopting a law, I believe it was last year, that clarifies that shared appreciation agreements are within the definition of residential mortgage loan. But that still leaves homeowners open to certain abusive practices, and this bill will fill that gap. Shared appreciation agreements require a huge balloon payment at the end. That payment is calculated as a percentage of the home value, and most people will have to sell in order to pay. But the payment is normally so big that it can prevent the homeowner from using their equity, which is, a lifetime of savings, for important life events like moving into assisted living or passing along family wealth, or even just refinancing when rates go down. The industry seems to target people with low credit scores who are cash poor and house rich. Longtime homeowners, older homeowners are particularly at risk. These contracts are extremely complicated and deceptively marketed. HB 5209 adds essential safeguards such as housing counseling, clear disclosures, usury cap, and it bans common abusive contract terms that we've seen. Now, you've heard industry representatives say they won't be able to do business if this bill becomes law. But frankly, I think that says more about this industry and the product than it does the bill. There are certain aspects of the shared appreciation loan product that differ from traditional mortgages, so it is appropriate that Connecticut law address those unique features. And that's what this bill does. We don't think there's anything in this bill that a reasonable lender should object to. Now, we've heard from some homeowners with shared appreciation agreements who have testified against this bill. I respectfully suggest that those homeowners have not yet reached the end of their contract, so they haven't been required to make a payment on it. I have heard from homeowners, borrowers in other states who have reached that point and who are quite upset when they realized how much money they owed. So I asked the committee members to please keep in mind that the borrowers who testified against the bill may actually change their mind when it comes time to write a check to the lender. I encourage everyone to vote in favor of this bill, and I'm happy to answer any questions you may have either now or later.
Thank you, Andrew, for joining us. I do have a couple of questions. One, just generally about the market. I suspect that you kind of track this in all 50 states. What are you seeing with respect to the growth of this industry or the pervasiveness of this product in different states? Has the industry been growing steadily? I mean, as long as I've been here, we have touched upon this and made some revisions to our statute, but haven't heard a lot, frankly, until today about actual consumers in the market and what kind of the market looks like in Connecticut. Can you comment on that for us?
Yes, it is growing. They're in the majority of states now, or at least they offer in the majority of states. I don't know how many customers they actually have. There's very little public data about these. Everything's privately held, not aware of any public reporting. Washington State did a good study on the industry there, and they produced some numbers, which I think we've indicated in our report or our testimony or some previous materials. I can share that if you like. But the industry is still much smaller than the traditional mortgage industry. And it's also new enough that not many homeowners have reached a point where they have to make payment on their loan. Most of these products are either, from what we've seen, a 10-year term or a 30-year term. Like traditional mortgages, most people don't actually hold it till term, but it's still new enough that comparatively small number of people have actually reached the point where they have to make a payment. As I said, we have heard from people who've reached that point, and some of them are pretty upset. There's a class action in Massachusetts against one earlier lender. There are lawsuits in a number of states, which NCLC has been involved in. But I think that's why you haven't heard too much from consumers. Is unlike traditional loans, you don't have to make that payment each month, so it's out of sight, out of mind, and people aren't defaulting because they're not required to make a payment. But in a few years, I think this will become a hotter topic.
Thank you. And the bill before us today, is it, do you know if these provisions have been adopted in other states, and if so, how many and where?
They haven't been adopted elsewhere. There are only a few states that have actually started talking about this. All the states that have adopted legislation have gone at least as far as Connecticut in declaring that these, or clarifying that they are mortgages. A number of states are debating this. Maine has issued an advisory opinion that comes down pretty strongly, generally along the lines of where Connecticut is leaning, but it's an advisory, it's a regulatory advisory opinion, not a law. They just debated legislation, and they actually, first the committee agreed on a 3-year ban on the product, which I think says something. Some more information's come to light a bit, so I think they may be reconsidering something else, something stronger. But the industry, CHEP, I believe is the acronym, has suggested bills in other states. Their bill has not been adopted anywhere. So states seem to be leaning towards strong regulation.
Okay, thank you. And yeah, I was going to reference, because I just brought it up and we heard testimony just before you. CHEP has submitted testimony. They have really, I think, 5 or so specific points that are most concerning to them. You can either respond to some of those or follow up, or I don't know if you have written testimony which responds to some of these. I don't want to go through each of them, but there's, you know, the usury provision, the third-party fee cap, early termination language, property improvements and valuation, and the mandatory refinancing. So again, you can address, I'll give you some time to address any of those in specific, but what might be better is to follow up if you have written testimony or would like to follow up and review their points if you're not familiar with them, and kind of respond if you could.
I can address some of those quickly, and I can supplement my written testimony. On the mandatory refinancing, I disagree with the process that they suggested. I don't think they'd be required to become lenders. I think it would be enough for them to have a partnership or an agreement with a licensed lender. And I think that would resolve that problem. As for the usury cap, yes, it's true that other lenders, mortgage lenders, are exempt from the usury cap, but they never come near the usury cap either, so it's kind of a moot point. These products routinely go over and exceed Connecticut's usury cap, and I think that's why it's important that it come into play. Other mortgage products have kind of a de facto usury cap in the form of Connecticut's high cost loan statute and the federal high cost loan statute, commonly known as HOPA. High cost loans, pretty federally and pretty much through all states, are subject to more extensive regulations. They're usually points and fee caps, which are kind of a form of the limit on the closing costs that were discussed here. And the reason for those caps is because the higher expense of the loans create a much higher risk of foreclosure. It's a much higher burden on the consumer. So it's fair to counterbalance that with some protections and restrictions. These products, although they don't have a contractual interest rate, usually have a very high effective interest rate. They're a very expensive financing product. So I think it's fair to put some restrictions on it, some guardrails to protect consumers. Trying to think of some of the other concerns they had, but I think those are the major responses, that this is a high cost product, so it merits some extra guardrails.
So just one brief follow-up on that. So this product now under current law wouldn't qualify, even though it is defined as a mortgage, wouldn't qualify under those HOPA provisions?
Yes, I believe it would be subject to the HOPA provisions as well. They just don't have a numerical rate cap. They're triggered by when the APR or some other contract clauses reach a certain level, then those laws start to take effect. And that has kind of a market deterrent on them because lenders usually don't want to be covered by that. But lenders can still make them. They're perfectly legal, and they could still make what we call HOPA loans.
Okay.
But what the Connecticut usury cap would do is would say, even if you don't care about being covered by HOPA, you just can't make a loan that's more than 12% simple interest. And considering the prime rates are around half that right now, I think that's a pretty fair cap. They're still going to get a pretty tidy profit.
Okay. Thank you. Senator Miller, that's a question.
Thank you, Andrew, for joining us today and for your testimony. You use the phrase, and I find it very concerning when a product targets, as you put it, individuals who have low credit scores, cash poor, and house rich. And so my question to you is, to your knowledge, how does the repayment work? Because nothing's for free. It's great that I don't have to pay a mortgage, because I saw this happen with the reverse mortgages, right? To a relative of mine. And in the end, once that person died, there was no equity left in the house. The family didn't receive anything from the house. It went to the company. And so my question with the agreements is, sure, they're not paying now, but as you said, at the end of the contract, there's a lump sum payment, right? So how does that work? Is there a percentage that they have to pay? Do they have to pay the principal, what they borrowed, and a percentage of the shares in the house or equity in the house?
Yeah, I think you've really hit the nail on the head. One of the concerns we have with these, and I'm a little worried for some of the witnesses who testified, people get these when they can't get other kinds of credit. So they're really kind of kicking the can down the road. And as you said, they all require a lump sum payment at maturity. That's how they're structured. It's calculated. The contracts vary widely. It's not like traditional mortgages, Fannie Freddie mortgages, where they're all pretty standardized. Every company has a different model. So they're all percentage based. Sometimes it's a percentage of the future equity. Sometimes it's a percentage of the total value of the property with some credit for, what you've already paid in. They vary widely, but the model usually is a percentage of the total value of the property or a value of the equity that has arisen since you signed the contract. It'll be a percentage. We've seen 20 to 70 or even 100%. Kind of whatever the company is willing to give, whatever the consumer is willing to sign. And when a triggering event occurs, which could be you reach the end of the contract, they're not like reverse mortgages where you stay in the house and you don't have to pay. Mm-hmm. Here, when you hit that date, you have to pay, like a traditional mortgage. If you want to sell, usually what happens is people want to sell the house or they want to refinance, and that triggers it. The company tells you how much you owe, and you have to find a way to come up with it. If you're not selling, you're going to have to liquidate assets, and most people aren't able to do that. Most people will have to sell to pay this bill. The way the formula is calculated is it usually does include the money that was originally provided plus profit. What we've seen in a lot of contracts is they appraise the house at origination, but what they do is they discount that origination, that value. They'll say, okay, your house appraises for 100,000, but we're going to treat it as if it's 85,000. What that does, they call it a risk adjustment. What that does is if at maturity on the contract, the house, say like the house value has stayed flat for 5 years, for whatever reason, it's still worth 100,000. They get another appraisal and they say, we take 15% of the difference, which 25%, whatever it is. So here it would look like there's a $15,000 increase in value because they adjusted the starting value to 85. So they pretty much, your house would have to plummet in value by tremendous amount for them to not make money on this contract. And that's one of the reasons we think it's unfair. They're using some complicated math, some projections to target houses that they're sure are going to go up in value. And they really build in almost 100% certainty that they will make all their money back plus a good profit. And the sum is going to force the homeowner to pay, or they're not going to be able to pass money along to the family or whatever the situation is.
So we said that at the end of these contracts, families are really usually surprised at what they owe. So you're saying that no statements, they don't get statements to let them know how much they owe the companies? The lender, the borrower?
It varies, like I said,
excuse me.
sure. It varies pretty widely. Some companies send various kinds of statements. Most of the companies seem to have a website where you can go check what you might owe at a certain point. But people aren't by the time they get to that point, they've already signed the contract. And if people aren't aware that they need to keep checking on this, they might not realize their situation.
Okay. Thank you. Education is very important to me. And as you stated, that people aren't usually aware of certain things. And I'm just finding that, the harder things get for people, the affordability aspect of life get for people, that they become desperate and they do whatever they need to do at the time and not really thinking about the unintended consequences of their desperation. And, it is concerning to me that we have these products that are popping up that are taking advantage of people. And, I saw I don't know if your testimony of the two individuals who do business with Point, and they're really happy with the product. But again, they came to them when they were desperate. And so, as you stated, at the end of these contracts, what happens? And they're going to have to pay this money that they they don't have the money, it's in the equity in the house, but they're losing so much. And I was going to ask you about the depreciation. What happens if it depreciates? Because it did happen, I believe, like the late 80s to early 90s, where the properties were worth less than the outstanding debt. And so how would that work if it should happen?
If the property depreciates enough, then the company will probably not exercise the option, and they won't get paid, and the homeowner won't have to pay anything back. But that's where I was referring to the risk adjustment. The way they adjust the numbers, properties would have to depreciate to an extent that is really unheard of. I think it's extremely unlikely that such a circumstance would come about. In Washington State, where they've done research on the contracts that have come to end, I think they found one out of, and again, it's still a small market share. I think there were 600 contracts they had looked at, and I think only one the company hadn't made any money on. And in that situation, it was a second mortgage. The homeowner had defaulted on the first mortgage. And, but that was just extremely rare. You look at traditional mortgages, people usually, even most mortgages, the lender usually comes out ahead. And these have contractual structures that make it even more likely that they're going to get paid.
Okay, I have one more question, Mr. Chair, if I may. So let's go back to your example of the $100,000 appraisal, and the company appraises at 85,000. How would they make their monies in that scenario?
Well, it goes to the way the payment is calculated at maturity. So at maturity, they look at, assuming the contract is just a straight percentage of the home value,
Mhm.
Let's see. Well, it's easier to explain if it's a percentage of the equity. If the property is worth $100,000 at the beginning and $100,000 at the end, and the creditor gets paid 10% of the equity, well, there is no equity because the property has stayed the same value. But because they use a risk-adjusted value, they're comparing $85,000 at the beginning and $100,000 at the end. So even though the property value has not changed from a market perspective, from a mathematical perspective, they see $15,000 in growth, and they would take a percentage of the 15,000.
I thought that's what you were saying. Okay, thank you very much. Thank you, Mr. Chair.
Thank you. Any other questions? Going once, going twice, seeing none. Thank you, Andrew. Appreciate your time today. Okay, thank you. And we are moving on. We have Louis Cadletts Peck joining us online. Afternoon, Louis.
Thank you, Representative Doucette. Thank you, Senator Miller, Senator Honig, Senator Berthel, and Representative Delnicki, and esteemed members. My name is Louis Cadletts Peck. I'm the Executive Director of the Responsible Business Lending Coalition. We represent over 1,000 small business groups, lenders, and nonprofits who've come together to improve small businesses' access to capital and responsible financing. We urge your support for HB 5211. Personally, I also started the small business lending program at a large for-profit fintech company, and I was an appointed member of the Federal Consumer Financial Protection Bureau's advisory board during the Biden administration. This bill builds on the foundation laid in 2023's SB 1032, and I'd like to share with you 5 key developments that have taken place in the 3 years since it passed. Number 1, the Small Business Administration found that merchant cash advances are leading small businesses to a very high fail rate, and they called merchant cash advances extortionists. Number 2, the New York and California Small Business Truth in Lending laws with APR came into effect in 2022 and 2023. MCAs are complying with those laws. Data indicates that access to capital in those states did not fall. It's just more transparent now. Number 3, Federal Reserve Governor Michael Barr gave a speech calling on states to pass small business truth in lending laws, highlighting New York's and California's, which require APR, as model. That speech drew on the 5 studies that the Federal Reserve has done, finding that small business owners want and need APR. The Biden administration's CFPB also called on states to pass small business truth in lending laws with APR. Number 4, to prevent that, merchant cash advance lobbyists have been flying around the country urging other states to adopt what they call the Connecticut model, which currently authorizes them to avoid disclosing the APRs they're charging small businesses, which can be in the hundreds of percent. 5, these merchant cash advance companies sued California to try to overturn the APR rules there. Senator Miller, I think you referenced that. The Ninth Circuit judges evaluated those arguments and rejected them. The judges found that estimated APR is, quote, purely factual, non-controversial, not unduly burdensome, and from the standpoint of small businesses, a disclosure that they have been requesting for years. Small businesses have been requesting this transparency for years, and every year that they wait is another year that millions of dollars are pulled out of the state by financing companies that are overcharging your small businesses because businesses aren't able to make informed comparisons between products. For this bill to work as intended, there are a few changes that are needed. We will submit written testimony describing them. Thank you. Thank you for what you're considering doing here today.
Thank you, Louis. Appreciate you joining us. I believe you were with us a few years ago when we last visited the regulatory aspect of this issue. I was going to ask you if you submitted written testimony yet, and specifically some interesting updates you had for us. I recall, I think it was your organization that had collected and given us sort of a 50-state survey at the time. I believe that was 2023. I'd be interested to see that, what that looks like now. If you could provide that to us, or or tell us, or both, how has the landscape changed since 2023? Which states disclose APR?
Thank you. One of the most interesting developments that I think is worth mentioning of state laws since then is just this past summer, Texas passed a law trying to crack down on merchant cash advances. We didn't entirely support that law. We had some concerns about it. But one thing that I wanted to raise to you about that is that law, like your existing law here, focused specifically and only on sales-based financing. New York and California law applies broadly. It applies to loans and lines of credit too, so that there's a level playing field of price disclosure. When Texas this summer in June passed this bill to particularly focus on merchant cash advances, by July, the merchant cash advance industry had essentially laid the groundwork to evade that law, and they were advertising business as usual in Texas because merchant cash advance companies were able to just to make a couple changes in their contracts essentially and recharacterize their products as being loans so they wouldn't be subject to this law. Thus far, the framework of 1032 essentially hasn't been restrictive enough on the industry. It hasn't required enough transparency to really be worth them trying to evade. But if you do pass a law that does meaningfully require a higher bar of transparency than what they were already doing, they will just implement the same thing they've done in Texas and evade the law.
Okay, thank you. Interesting. Any other questions for Louis? Senator Miller.
Thank you, Mr. Chair. Hello, Louis, and thank you for testifying before us today. Louis, question, you said that there would have to be some changes and you would send those changes over to us. Can you discuss those changes to the bill that you think would make it more effective?
I'm so grateful you asked that. Thank you, Senator. The first one is one of the things this bill does is bring over the New York framework for APR transparency. But the current draft left out a really important part of that, which is the requirement that financing companies, when they're disclosing their APRs, don't just do it kind of one time in a box where it can kind of be dismissed as fine print, but that they do something like how the Truth in Lending Act works in consumer lending, which is you have to, when you're quoting a price, you have to always tell people the APR once it's been disclosed. This is actually a narrower requirement in Texas and California than under the Truth in Lending Act. California originally didn't have this piece, and they saw that it was missing. And so in August of this year, California unanimously added this part that was in Texas's law so that they would come into harmony, interstate harmonization, with New York's law. And so the one thing I would really note is you don't want your transparency to just be like a fine print box. You want it to be part of the characterization of prices and fees. And also part of that New York and California framework now is that it doesn't just say you have to do this box one time. It also says you can't quote prices in ways that are misleading to people, because something that might not be obvious if you're just reading the text of the bill is the problem isn't just that financing companies aren't disclosing that they're proposing to charge a 200% APR or 50% APR, whatever it is. It's also that their marketing teams do what my marketing team did when I was in that position, which is you look at how do you characterize the pricing in a way that convinces the most people that it's a good deal. And so what the Federal Reserve has done is study this and found that financing companies are coming up with basically new metrics of describing prices. Like they'll say your simple interest is 9%. And then the Fed says, well, that's equivalent to a simple interest rate of 34% and an APR of 45%. So using simple interest that way is deceptive. So that's one change. The second one is the definition of who it applies to, who's a provider. It's overbroad in one place and too narrow in another. Third is a compromise that's been struck in other states with companies that have been reluctant to disclose their APRs is something that you could consider including here, which is a more explicit safe harbor for estimated APR some of these companies will say, gosh, we just can't possibly disclose the estimated APR that we propose to charge. I mean, that's really nonsense. They're doing it in these other major states. Of course, they know what they expect to earn on the deal. They couldn't underwrite it. They didn't know what they expected to earn. But in some cases, they do feel more comfortable if you add language that says that if the estimated APR diverges as from the actual effective APRs, the financing is repaid, that doesn't cause them liability. And we've supported that. And that could be something to cover. And then the fourth and last recommendation that I would make is that if what your goal is to help small businesses identify what financing options they have and compare prices with reasonable information that's available to figure out what is the best deal available to them, what do they want to choose, you're not going to accomplish that if you're just requiring transparency on a merchant cash advance, because small businesses are not out there trying to get a merchant cash advance. They're trying to get capital. And when they're trying to get capital, they're considering merchant cash advances, loans, lines of credit, invoice factoring. One of the folks opposing the bill made the same point. This was Diana Koch, from Chief Legal Officer of Funders Group, LLC. And she was absolutely right in saying that it's probably not the best approach to just have transparency for a merchant cash advance if it doesn't allow them to make an informed comparison with their other options. So we would advocate for doing what New York and California have done and just having a level playing field of transparency for small business financing generally.
All right, thank you, Louis, and thank you, Mr. Chair.
Thank you, Madam Chair. Any other questions for Louis? Well, thank you again, Louis, for joining us. And yes, please follow up with that other information that you referenced.
Thank you.
Thank you. Okay. Next, we're going to Adam Schwartz. It's online. Followed by Kate Fisher. Hi, Adam. You're up. Please proceed. You're on mute. There you go. Oh, still.
No.
Adam, still can't. Try it again.
Hi,
There
can
we
you hear
go.
me?
I can hear you now. Thank you.
Okay. I have one little glitch. I happen to be at a business center in a hotel, and they seem to be doing construction next door. So I'm getting a lot of buzzing. So I don't know if we could take a chance, or you want to maybe put me on the slate for 1 or 2 more slots so I can get this resolved, because I don't have this bang in our background.
We actually hear you just fine right at the moment. So
Okay, so I'll try. Hopefully it goes through well. Thank you for having me here today. I'm here today on behalf of a Connecticut funding company that provides working capital to small and mid-sized businesses, including many Connecticut merchants who rely on fast access to capital when traditional financing is not available. I respectfully oppose Ray's bill, number 5211, because while intended to protect merchants, the bill will have unintended consequences of reducing access to funding for the very small businesses it seeks to help. The businesses that come to us are rarely operating from a position of comfort. They are often facing immediate financial pressure, payrolls, deadlines, inventory, opportunities, seasonal expenses, or just unexpected disruptions. For these merchants, timing is everything. Our underwriting process is designed to evaluate risk quickly, and once agreements are executed, funding typically happens within 24 to 48 hours. A mandatory 7-day waiting period fundamentally changes that model. In practical terms, it eliminates the usefulness of the financing product for the emergency or time-sensitive needs. Merchants who cannot wait will seek funding from out-of-state providers or lose access to capital entirely. The result is not increased protection, but reduced availability of financing within Connecticut. The bill also removes access to ex parte prejudgment remedies for the specific category of commercial agreements. These remedies are long-standing judicial tools available throughout commercial law and are critical to managing risk where assets can be quickly transferred or dissipated. Without meaningful enforcement mechanisms, underwriting risk increases substantially. When risks increase, funding approvals decrease, and the costs rise, outcomes that ultimately impact small businesses, not funders just alone. Equally concerning, is that this legislation singles out one lawful form of commercial financing while leaving other commercial agreements, including leases, loans, equipment financing, etc., unaffected. Treating similar situated commercial transactions differently without a demonstrated record of widespread abuse raises serious policy and fairness concerns. We respectfully urge the committee to reconsider or substantially revise this bill to ensure that merchant protections are not unintentionally restrict access to small capital for Connecticut's small business community. We support reasonable and balanced regulation that promotes transparency and fair dealing. However, policies that delay funding or eliminate established judicial remedies risk driving capital providers out of Connecticut and limit financing options for local businesses. Thank you for letting me speak.
Thank you, Adam. Appreciate it. And you sounded crystal clear. I didn't hear anything on my end, so hopefully it quieted down. Any questions for Adam? Okay, seeing none. Thank you, Adam.
Thank you.
Kate Fisher. Followed by Matthew Windsor. Welcome, Kate. Thank you for your patience.
Thank you, Chair Doucette. And good afternoon, Chair Doucette and Chair Miller and members of the committee. My name is Kate Fisher. I'm a partner with the law firm Hudson Cook in Hanover, Maryland. I represent the Revenue-Based Finance Coalition. This is a group of responsible finance companies that provides capital to small and medium-sized businesses. And in my own law practice, I represent a pretty large number of providers of commercial financing, including sales-based financing, to provide regulatory advice to these companies on how to comply with different state and federal laws. We respectfully oppose House Bill 5211. It sounds like a major concern here is the PJR, and the Revenue-Based Finance Coalition is supportive of expanding Connecticut's PJR ban to cover all sales-based financing transactions. This is in line with the coalition's best practices that prohibit members from requiring a confession of judgment or a cognovit as a condition to obtaining financing. We do respectfully oppose two elements of House Bill 5211. First, we oppose the proposed estimated APR disclosure. You might hear from folks who opine that estimated APR is a gold standard of cost comparison, but it's not. In the last few years, 9 states have rejected requiring an estimated APR disclosure for sales-based financing. And Chair Doucette, you had asked about what states do require an estimated APR. It is still only California and New York, the same as in 2023. There are 3 reasons why we oppose requiring estimated APR. First, estimated APR is not the same as APR from the Federal Truth in Lending Act that applies to consumer transactions. This is a disclosure made up by the state of California, adopted only in California and New York. And rather than disclosing the expected cost of financing, estimated APR requires a financing provider to guesstimate a payment schedule based on one of 2 unreliable methods. And one of these 2 methods that's allowed for calculating the estimated APR is called the opt-in method in the legislation. It's so likely to be unreliable that a provider who elects to use the opt-in method would be required to annually report to the commissioner on how well or poorly the financing provider guesstimated that estimated APR. The result is an estimated APR disclosure that's misleading and will cause confusion rather than help businesses. And even if estimated APR is the gold standard, and there's evidence to the contrary, House Bill 5211 would require estimated APR for only one product. And as a result, there's no meaningful comparison here to be done. Finally, Connecticut's current disclosure law is working well. I am not aware of any problems related to the disclosures. There have not been any reported administrative, enforcement, or operational complications for the Department of Banking that would suggest the existing Connecticut framework is unworkable or deficient. So for these 3 reasons, we respectfully oppose the estimated APR disclosure. We also oppose a 7-day right to cancel. This proposed 7-day rescission period, and it's not a waiting period, it's a right to rescind. It's far longer than what Connecticut requires for consumer transactions such as door-to-door sales, home equity loans. Both of those transactions under Connecticut law
3 minutes are
require
up. Please wrap up your remarks.
a 3 business day right to rescind. And it is our view that that 7 days is too long. I'll be brief. In addition, the committee already solved for this issue in 2023 by prohibiting a sales-based financing provider from revoking or modifying a specific offer until midnight of the 3rd calendar day after the offer. Connecticut is the only state in the country with this 3-day period for the offer. And it reflects this committee's thought leadership and provides a 3-day buffer from high-pressure sales tactics. So in our view, no additional cooling off period should be necessary. If the committee thinks it is necessary, we would recommend 3 days. Thank you.
Thank you, Kate. Appreciate it. I did have one question for you. We heard a reference earlier to a decision of the Ninth Circuit with respect to the APR provisions in California. Did I have that right?
Yes.
Would you like to comment on that or explain that a little more? I haven't really reviewed it or read it. I just kind of heard about it this morning, basically. So
Yes, I'm so glad that you asked me that. A trade association sued the state of California, claiming that the requirement to disclose an APR or estimated APR in connection with certain commercial products violated the First Amendment free speech rights of financing providers. The court applied the test for whether or not compelled commercial speech violates the First Amendment of the U.S. Constitution. And that test includes whether the statement is purely factual. I think there's a 3-part test. And when you read that decision in a vacuum, it sounds like very strong language that the Ninth Circuit Court of Appeals is blessing APR, saying this is important. In fact, that standard has been applied to all kinds of commercial speech. So one example is that Kimberly Clark sued the District of Columbia a few years ago because DC prohibited them from describing their moist disposable towelettes for use in the bathroom as flushable. And the court had to decide, is flushable a purely factual statement? And the other pieces to the test that I can't remember offhand. So it is an interesting decision. I do recommend reading it. But the issue was focused on whether it was compelled commercial speech that violated the First Amendment.
and you're bringing me back because I do remember in 2023 kind of dipping our toe in that conversation. And I was very skeptical then. And I suppose I'm more skeptical now, unless you tell me that is on a rocket appeal to the Supreme Court and we're going to hear otherwise. Do you know what's the current status of that?
Gosh, it is definitely not on a rocket appeal. It may have been appealed. I can't remember. I don't view it as particularly relevant whether this compelled speech violates the U.S. Constitution. I think the relevant question is this helpful? Is this a meaningful disclosure?
I appreciate that. Okay, any other questions for Kate? Anyone going once, going twice? No, that's it. Kate, appreciate you being here in person today. All right, next is Matthew Windsor, who's with us online.
Yes. Hi, can you hear me?
Yes, we can.
Okay, great. Thank you very much. Thank you, co-chairs Doucette and Miller and ranking members Berthel and Hauja for the opportunity to comment in opposition to House Bill 5209 concerning shared appreciation agreements. My name is Matthew Windsor. I'm Deputy General Counsel at Point Digital Finance. We're one of the nation's leading issuers of shared appreciation agreements, the first SAA company to be licensed as a lender in Connecticut, and a founding member of the Coalition for Home Equity Partnership. Point has enjoyed working closely with the Connecticut Department of Banking since its licensure as a mortgage lender in 2021, and we were successfully examined by the department in 2023. We've been happy to support Public Act 21-138, which made Connecticut the first state in the nation to regulate and license shared appreciation agreement lenders. We have also helped the Department of Banking develop reporting and disclosure requirements, establishing a clear and effective regulatory framework for these products. That is why we, along with other CHEP members, were also strongly in support of Public Act 25-115, which codified SAA-specific disclosure requirements into law last year. Through our home equity investment product, we've helped over 23,000 homeowners nationwide, including nearly 300 here in Connecticut, access their home's equity. You heard from some of them earlier today. We've provided over $27 million in funding over the last 5 years in Connecticut alone. Our customers are regular working people. They have an average age of around 55 and a median home value of around $425,000, which is identical or very close to the median home value in Connecticut overall. These are residents that have owned their homes for nearly 15 years. They've been responsible for making their mortgages and tax payments, and they have built up equity in their home. For a large number of them, the equity in their home is their single biggest source of wealth, but it can be difficult for them to access it. Like many people, our customers face financial challenges, such as high debt loads from credit cards, medical bills. You heard from the examples earlier, perhaps property tax payments. They may have educational expenses, or they may simply have an inability to raise capital to fund their own business or to make other investments. Traditional home equity products like HELOCs have substantial limitations that make them impractical for many homeowners. One of those is a requirement for a relatively high credit score. Most HELOC originations since 2024 go to borrowers with a credit score above 760. Connecticut's average credit score is 726. But qualification isn't the only barrier here. HELOCs fundamentally create additional debt with monthly payment obligations. According to our own research, almost 70% of homeowners considering a shared appreciation agreement reported that they could qualify for a traditional mortgage payment, traditional mortgage product, but did not want a monthly payment. For homeowners already stretched thin by rising taxes, insurance costs, living expenses, taking on another monthly payment simply won't work. And I think, again, you heard from some homeowners earlier in the session about that. That is why we oppose this bill, because it would strip many Connecticut homeowners of the only practical way to access their home equity. As my colleagues Lee and Jesse from HomeTap and Unlock have discussed and will discuss in more detail, this bill is full of provisions that are unworkable, unfair, or simply misconsidered. As demonstrated by our licensure as a lender and our support of past legislation, Point and the rest of CHEP does not oppose regulation of shared appreciation agreements, but it should be reasonable, proportional, and most importantly, continue to allow homeowners the ability to access the value in their homes.
Okay, thank you. Any questions for Matthew? Seeing none. I appreciate you joining us, Matthew.
Thank you.
Next on my list is Cynthia Labe, who I do not see online. No? Okay. So we're going to skip Cynthia. Next on our list is Bruce Adams, who is not with us. I believe I was informed that he is under the weather today. I don't see him online. So we're going to skip Bruce for now as well. Next would be Lucas Rockland, who is with us today. Welcome back, Lucas. Good to see you.
Is that better? Can you hear me?
Yep.
Yes,
Okay.
thank you.
Good afternoon, members of the committee. I want to thank you for allowing me the opportunity to speak today. I understand I only have 3 minutes, so I'm going to try to move this along as quickly as I can. I'm an attorney at the law firm Newbert Pepe Monteith. One of the practices at our firm is representing our creditors. We do so in transactional matters. We do so in workout and litigation matters. Our clients are banks, finance providers, including sales-based providers, commonly known as MCA funders. We represent them in litigation matters and in some compliance matters as well. Generally speaking, our law firm, our clients are supportive of a reasonable, balanced legislation as it relates to the MSA product. It provides transparency and clarity and provides guidelines. I think that's a good thing. So we're not in court litigating about what's permissible and what's not permissible. We understand that Representative Jacobson, he's the principal author of this bill. It's my understanding. I spoke to him last week about this. And this committee knows he's an attorney that represents and defends some of the actions that are brought by the MCA funders. And we've been on the opposite side of a couple of cases. And I've certainly found him to be professional and a gentleman, and I appreciate the work he's doing. Do we just disagree with some of the bill? We believe the bill 5211 as drafted is unnecessary in light of the recent public act that this legislature passed just 2 years ago. We also believe it's unbalanced and overly broad. As the committee knows, Public Act 23-201 was enacted in 2023 to create transparency in MCA financing. It requires detailed financial disclosures. It requires annual registration with the banking commissioner. Made restrictions to use of PGR waivers. It grants enforcement and civil penalty authority, and that framework is less than 2 years old. 5211 does not just refine that framework, it greatly expands it. It removes the $250,000 cap, mandates APR disclosure, creates ongoing APR reporting and regulatory oversight, imposes new contract restrictions, adds a 7 business day cancellation rate, and bans PGR waivers for this industry, raising potential constitutionality concerns. Taken together, these would create the most expansive and restrictive regulatory framework for sales-based commercial financing in the country, going far beyond what states like New York and California require. In the sake of time, Attorney Fisher already talked about APR. I'm not going to discuss APR. Only 2 states have APR. I think 8 or 9 states have statutorily regulated the MCA product. Only 2 have required APR, and there's reasons. Therefore, it's not a loan. Repayments are tied to revenue, which can change, and so APR in some instances can be misleading. The bill does create ongoing reporting and regulatory oversight in addition to APR. So you're projecting what the APR is going to be, and then after you're supposed to square up what was the effect of APR, not just the projected. And so because regulatory oversight, no other state has that. The 7 business day cancellation, no other state has that. I know Attorneys Fisher and Attorney Alphen commented about that. I do want to reserve the remaining time to talk about this PGR ban. Public Act 23-201 already struck a balanced approach. For financing above $250,000, PGR waivers remain permitted, although as of October 2025, the provider must now file the lawsuit within 12 days of attempting attachments to ensure prompt court oversight. Okay, for financing at or below $250,000, PGR waivers are restricted until after the case is filed. This framework represents legislative calibration.
Your 3 minutes are up. Please wrap up your remarks.
Okay, it preserves remedies in larger transactions while adding safeguards for the small ones. This proposed bill bans the waiver for just in this industry for all MCA financing. It does raise some constitutional concerns. Most financing, the vast majority of financing, MCA financing, is substantially less than $250,000. Companies that can qualify for financing of over $250,000 are larger, more sophisticated companies. They have professionals, they have accountants, they have lawyers. They understand what these waivers mean. I don't think the legislature needs to protect those. It's an important product. A default in an MCA is not a non-payment. A default in the MCA is a bad act. It's when the business is still operating, generating revenue, and then intentionally not allowing the MCA funder who purchased a percentage of that revenue to receive that revenue. They often do it by calling their bank and issuing a stop payment on the bank account, which triggers an ACH code R08. And so they receive the funds, they just don't remit them. And so then, yes, the funder would like to try to get security for that bad act. Okay, and so the PGR waiver is very helpful for that. There's all these procedural safeguards. It's a policy. It's a procedure that goes back to the early 70s.
Okay,
so
I think you can wrap up real quick, but
if I could just say one thing.
Sure.
Just a ban is, if this legislature believes that further legislative review is needed with respect to the PGR, we would just ask that it be targeted and balanced. You know, banning it outright is a blunt instrument, and so that's the last thing I wanted to say.
Okay.
Thank you.
Appreciate it. And thank you for coming back again this year. I know we had, pretty in-depth exchange last year. So we have the benefit of having had that discussion and I think being generally familiar with the issues, but appreciate you coming back. Any other questions for Lucas? Senator Miller?
Thank you, Mr. Chair. So thank you, Attorney Rockland, for visiting us once again. We appreciate your point of view. Attorney Rockland, question, and I believe I asked you this question last year. Have you had to pursue any court action on any of your clients' lenders or borrowers?
Yes, one of the services we provide for the MCA funding community is litigation, if that was the question. So yes,
Right.
we filed cases in the Connecticut Superior Court, yes.
And so, are your clients, and I hope you can, without breaking confidentiality, are your clients, do any of your clients do business outside of the state of Connecticut? Or are they headquarters outside of the state of Connecticut?
Yes, so some of the clients have offices in multiple states. Many of the MCA funders are providing financing around the country. That doesn't mean that they have offices in all 50 states. They sometimes have offices in multiple states. Our clients have offices in Connecticut, though, if that was the question. Some of our clients have gone so far as to purchase real estate in Connecticut. Connecticut benefits monetarily from this industry. And we'd like to see that there's professionals that are employed, the court systems benefit realtors, homeowners. So, but to answer your question, some of our clients have offices in multiple states. The states that you would see predominantly would be Florida, New York, and Connecticut, is what I see in our practice.
So to your knowledge, when this when this product first came to my attention a few years ago, based on an article, I believe it was 2022, the author of the article stated that it was easier to file suit here in Connecticut than any other state in the United States, and that's why a lot of these cases are filed here. So yes, it does bring work here and jobs to our residents here. But do you know if that is in fact true, that our law is unique when it comes to filing suits for this product?
Yes, so it's a great question. So our office reads all of the MCA cases that come out each month. We do so for the cases that come out of the entire nation, and we've done it for years. So we know the case law very well. Connecticut has a creditor-friendly tool, this prejudgment remedy. That has certainly been an attractor for the MCA industry. That is not the only reason, though. I like to think that there are very good practitioners in this space. I think that would include my law firm and some other law firms in the state, that we provide very high levels of service. The court system in Connecticut has rendered many decisions on the MCA law, and the courts have found these products to be fundamentally different from loans, and there's good reasons why, and that they're enforceable as such, despite the common defenses we see that these are unconscionable, they're usurious products, they're predatory. Those defenses are raised all the time in our cases, and those defenses very rarely succeed. I know Attorney Jacobson, Representative Jacobson, highlighted that there are some cases out there where courts have found MCA funders to be bad actors and have recharacterized their products as a loan and imposed usury laws or RICO laws and things of the nature. It's a very, very minor percentage of the cases. It's like a handful of cases out of the federal court in New York, but the vast majority of the cases, even today, find that it's a different product. It's not a loan. It's enforceable as such, and that these common style defenses are insufficient and do not defend. So, but to go back to your question, it's one of the reasons why funders have come to Connecticut. One of the reasons, not the only reason, is that Connecticut has a creditor-friendly prejudgment remedy tool.
So, question, for example, if I was a resident of Louisiana and your funder decided to sue me for default on my loan and they retain you, what does that process look like?
Sure, an action would be commenced here in Connecticut. An action would be commenced here in Connecticut. If it wasn't commenced here in Connecticut, it would be one of the other states, New York predominantly. New York still the state that has the most litigation in the MCA space. But the action would be commenced here in Connecticut, and it would be done so by virtue of the fact that the underlying MCA agreement would have a form selection clause requiring that litigation, should there be litigation after a default, that it would occur in the form as selected in the contract, and that would be Connecticut. In order for Connecticut to have and to be able to hold that case in Connecticut, there needs to be personal jurisdiction. So there needs to be things in addition to just simply putting Connecticut in the body of the contract to say that if litigation ensues, it'll be brought in Connecticut. There needs to be more badges. There needs to be more of a nexus to Connecticut for the Connecticut courts to not dismiss the case to find that there's lack of personal jurisdiction over the Louisiana merchant parties in your example. Okay, and so we have faced these defenses numerous times. We've prevailed on all of them because Connecticut, like most states, honor form selection clause in commercial agreements. And our clients have, they have businesses in Connecticut. They advise the seller parties that they have offices in Connecticut. They often do pre-funding calls before the financing occurs, and they go over the key material terms, including saying that they have an office in Connecticut and therefore Connecticut law applies. So there's lots of reasons why Connecticut can hold a litigation case despite the fact that the other side of the transaction may be located outside of Connecticut.
So you said a nexus to Connecticut. Would a post office box in Connecticut be an example of a nexus?
Well, it's not best practices. I mean, these are not black and white issues. If the company is registered to transact business in Connecticut, and do business in Connecticut, just like there are many companies that transact business all over the nation, but don't necessarily have physical offices or even personnel in all 50 states. I don't know that that's a requirement to use. I don't think that's a requirement in any state to use the court systems.
All right, thank you for entertaining my questions. I'm not an attorney, so you're educating me. That's why I'm asking you these questions.
I really do appreciate the questions because there's, a lot of charging words and big adjectives and sound bites used by a lot of the speakers here today to characterize this product and the practitioners as maybe, we heard the word predatory lending. We've heard all these different, adjectives. Some of it may be warranted as to some of the bad apples in the industry, but I don't think the industry as a whole is deserving of some of those phrases.
Okay, so, and this is also to shed light on this industry for the public, right? To educate the public on this product as well. So I'm in Louisiana, you're the attorney, you file a suit and an action against me. And so would I have to retain an attorney in Connecticut or show up, pro se, to represent myself in Connecticut from Louisiana?
Correct. But I would repeat that if the lawsuit's not in Connecticut, it's going to be in New York.
Well, I'm talking about Connecticut now. I don't know about New York. This is an example of Connecticut.
If you have a financial product in all 50 states, you're going to centralize, the litigation out of one specific state. You're not going to employ attorneys, and the law doesn't require that for you to employ attorneys and start actions in all 50 states. So what occurs in Connecticut is largely what occurs in New York. The laws are between the two states are, the Connecticut laws interpreted the product the same way that New York has. It's a difference without a distinction with respect to how the courts interpret the enforceability and the form selection clause and personal jurisdiction. But to answer your question, Your question?
No,
Yeah.
well, no, not really, but we're in Connecticut. The example is in Connecticut. You're an attorney in Connecticut, and I had asked you the question based on your experience. So, yeah, I'm good. I was just trying to get some clarification on how the process works, because if we're going to make a change, I need to know how the process works. It's like looking under the hood and say, oh, you don't need this, you don't need this, you don't need this. And so you're saying that it is what we have before you today is not good policy. And so I just needed you to just lay out the groundwork for me so I can make an informed decision whether it is good policy. So again, thank you, Mr. Chair, for allowing me this time to ask the questions to Attorney Rockland. And, Attorney Rockland, thank you for coming before the committee
There's one thing that might be helpful. Essentially, these cases in Connecticut are handled remotely. And what happens when out-of-state defendants get sued is they will Google MCA in Connecticut, and there's no shortage of MCA defense attorneys, Attorney Jacobson and other practitioners, Pullman and Conley, and there's some other law firms we generally see on the other side. They advertise their services. They receive the phone call. They enter an appearance. Cases are remote. So, in today's day, it's not, the out-of-state issue sounds significant. In practice and reality, we don't view it as such.
Okay. All right. Well, thank you. And I really appreciate you taking the time to answer my questions. Thank you, Mr. Chair.
Thank you, Madam Chair. And you have me on retainer too, and my fee is, well, non-existent, pro bono. So pretty good. All right. Any other questions for Lucas? No? Okay. Seeing none. Thank you,
I
Lucas.
very much appreciate your time. Thank you for your important work you did.
Thank you. All right. We're going to circle back to our friend Bruce Adams, who has joined us now online.
Thank you, Chair Doucette, and thank you to the committee for indulging my skipping a position in line. As you can tell, I'm under the weather, believe it or not, despite a flu shot. Say again?
We can tell already. Yes, we believe it.
Well, despite my flu shot, I still got influenza B. So take that for what it's worth. Wash your hands. So on behalf of Connecticut's credit unions, and they're nearly 1 million members, I offer testimony today primarily in support of Senate Bill 216, an act concerning the Community Bank and Credit Union Investment Program established by the state treasurer. However, I am prepared to discuss the concerns we will address in our written submission regarding the mortgage payment bills, specifically 217 and 5212. But in the interest of time, I'll just get through my piece and accept any questions from the committee. As we know, credit unions are uniquely valuable players in the banking space because we're cooperative businesses owned and governed by the very same people who do their banking with the credit union. And we call our customers members to reflect their special status as owners. So anything that is an operational drag on us tends to come with a cost and comes out of the people who deposit and take loans from us out of their pocket because they're the owners of the organization. With respect, however, to Senate Bill 215, I'll just go in numerical order on the escheatment bill. That would allow financial institutions to treat an inactive account as active for the purposes of escheatment, so long as the depositor actively maintains a separate account at that same institution. And that seems great on the surface. It seems like it's more efficient for us, and to some extent it is. However, if there is an active depositor at a financial institution, that person is not hard to reach. So query what the underlying purpose is here. I know it's difficult when dollars get escheated to the state, and trying to get your $37 or $3,700 out of the unclaimed property fund is a challenge. But to allow a financial institution to fee an account on one hand while maintaining an active relationship with the depositor on the other doesn't really pass the smell test to me. So what I would do is I would commit to working with the proponents and the stakeholders of this bill, or transition over to the treasurer's bill and GAE to smooth out those things where we can primarily protect the consumer and protect the operational efficiency of the credit unions and banks. With respect to 216, This expands the authority of the treasurer to accept a more affordable price for its investments in community credit unions and banks. And this in turn allows eligible Connecticut credit unions to help individuals build financial resilience by expanding access to credit, to affordable credit, for those borrowers that need it the most. The Treasurer's Office did solicit our contributions to the bill, and we gave our support. That said, a late-breaking issue arose within our membership to request one additional change to permit the Treasurer to allow some or all of the available funding to be allocated among the applicants. And that would allow for eligible applicants to receive potentially more of that money to do more good work on the street in Connecticut with their borrowing. We have instituted that secondary discussion, and we look forward to working with the Treasurer to craft mutually acceptable language. And in the interest of time, I will pause on my brief overview of 217 and 5212 because it's been treated here today, and I will save that time for the committee to ask questions of the credit unions about off-cycle or additional mortgage payments. And thank you for your time.
Thank you, Bruce. Any questions for Bruce? No? Oh, yes.
Senator Berthel.
Thank you, Mr. Chairman. Bruce, good to see you. I'm glad you're not here in person if you're not feeling well. We appreciate that, but I'm sorry that you're not you're under the weather, so to speak. I think you texted me earlier. You were listening to the conversation regarding the specifically 217 and 5212. Were you able to acquire any information regarding what our state chartered credit unions do with partial payments and how they process them?
I have not gotten data that I would with a straight face present to this committee as proper data out of our industry. But what I have gotten is sort of qualitative or quick responses saying basically that if any dollars come in, we'll take it and we'll put it on the account. I had that experience with every mortgage I've ever gotten, and I've gotten them from banks and credit unions. That I do think there is a challenge when the account is already delinquent or when that partial payment would cause the account to become delinquent. There are some operational burdens as our, my friends in the Bankers Association described, being able to adapt in the moment of payment when it's less than the full amount can be a challenge. I don't think it's an insurmountable challenge. I think it on its face, it's a little unfair if a person is coming up with some money to try to pay their loan, that our financial institutions should be there meeting those borrowers where they are and working to help them avoid damaging delinquency and default. So whether it's accepting that payment and segregating it into a side account where the borrower can save for that payment, and maybe that causes the financial institution to avoid reporting the delinquency for a month because the borrower has some skin in the game. I don't know. That's thinking off the top of our head, but all I know is that what credit unions try to do is help people gain financial independence and well-being. So wherever the money comes from, we're going to figure out a way to credit it, account for it, and help that borrower become or maintain current in their loan.
Okay, thank you. I appreciate all of that commentary. I think we'll have to take a look at the legislative intent of 217 and 5212 and see if we maybe have not hit the mark yet in terms of the language, and it has to be tweaked a little bit. But thank you again. Thanks for jumping on, and I hope you feel better. Thank you, Mr. Chairman.
Thank you, Senator.
Thank you, Senator. And Senator Miller.
Thank you, Mr. Chair. Hello, Bruce, and I hope you feel better. I won't keep you long. I just have a quick question on 217.
Of course.
What is your position about educating the borrower about paying additional monies on their mortgage?
Yeah, so that's an excellent question, and I didn't quite know how to fit it into my written testimony or my oral testimony, so thank you for opening the door. What Connecticut's credit unions have done in recent years is invest in a program called FICEP, where we certify financial coaches and counselors at no cost to anybody who comes in with questions. Even if they're not members of the credit union, And part and parcel of that is to pay your debts down fast and first, right? That's sort of rule number one, where you can meet your current expenses to pay down, your most expensive debts. And so credit unions endeavor either through this program or just naturally in their business model to help people do that. And so we will oftentimes credit unions educate their members directly, and at the point of sale, I guess, or transaction, when a person comes in seeking a new loan, let's say for a new car, but they've already got a student loan and a home equity loan and 3 or 4 other loans, those credit unions will look at all of those together and try to harmonize, consolidate where they can, educate the borrower about how to get the same amount of credit for less cost. Because that's why we were built, right? It's people helping people. So if you and I are members of a credit union, I want as good a loan rate as I can get on my loan. And you want that too, right? Because that helps, your money and your account work harder for you. So we're all in it together. So it's just a natural market force within the credit union. So education is key on that.
I'll talk to you offline. I just need, because you're not feeling well, I just had a couple more questions on that. So if I can give you a call in a couple days.
Absolutely, Senator. And I will say that, there's one key moment, right? Is before and after closing. So how much before closing are you doing education? How much sort of around the time of closing are you doing education? And then certainly how much after closing. And I think if our conversation looks at those 3 time periods, we might have a more productive conversation about what can be done in each of those phases.
Thank you. You hit the nail on the head. I had someone call me frantically. She's buying her first home and she's freaking out because she didn't know that she had to go through the process that she's going through and that there were all these costs and so on and so forth. And I just think that financial institutions need to do a better job at educating their their borrowers. I do, because we don't know. We're not the experts. The financial institutions are in this industry. So thank you. And I hope you feel better, Bruce. And
Thank you,
I'll give you a
Senator.
call in a couple days.
I appreciate that.
Thank you, Mr. Chair.
Rep. Telnicki.
Thank you, Mr. Chair. Quick, bless you. I think you sneezed. Credit unions are, by my recollection, conducting financial literacy training so that people can actually learn how to dig their way out. Is that true?
Well, if you're talking about financial literacy, especially in the legislative context, I think you're probably referring to the recent legislation for our high school graduation requirements. Is that correct?
More or less. And I say that more or less because that has a structure to it per se, and everyone has to go through it. My question again goes back to, if you have a member and they're having difficulties, are you or are the credit unions extending financial literacy help so that they can actually work their way out of the hole that they conceivably could have dug themselves into?
Yes, Representative. I think that's an important note to key up here, because if we look at the credit union's performance during the COVID pandemic, what we see is not just sort of charity being blanketed out on the community of borrowers and depositors, but what we see, or what we saw, was credit unions, allowing borrowers to change the terms, but also help them make plans to become current, right? Like, as we say in credit union land, we're not for profit, not for charity, but for service. And the people we serve are our members first. And so if somebody can't pay their car loan, and let's say they have a home loan with the credit union itself, and they need their car to get to work, like, that's a reasonable conversation you can have at your credit union to say, I want to be able to keep paying you on my house, but right now I got to fix my car and I don't have the money. And those conversations happen all the time. That's why we invented relationship banking. That's why we do the education, because we don't want to pick the pocket of member B just because we're, and let member A flounder, right? We don't want member B to subsidize the losses of member A. We have to think about the best interest of the individual and the needs of the collective.
And likewise in Senate Bill 216, do you see that as a plus, minus, or neutral for credit unions?
No, I think it's a plus. And I will say, I think it's a plus for small community banks too. This is not really a competitive issue between banks and credit unions. What it is an opportunity for the state of Connecticut to put more affordable dollars for lending out on the streets for the people that need them the most. And that builds financial resilience in the state. So, go ahead.
On board then.
Say again, Representative.
You're wholeheartedly on board on that?
With the community bank and credit union program, yes, I am. And I did request one additional change, that we allow the treasurer to allocate available funds among the applicants so that they are not restricted to a certain dollar amount based on their size.
Well, I thank you for your answers and appreciate it. And I hope you feel better.
Well, yes, thank you, Representative. And I know I'm not in person, but it's great to see you back in the committee.
Thank you. Likewise.
Thank you, Representative. And thank you, Bruce. Please get some rest.
Will do.
See you again soon. All right. We are moving on to number 22 on our list. Jesse Silverman is joining us online. Good afternoon, sir.
Thank you. Can you all hear me?
Yes.
Excellent. Thank you, Chair Doucette, Chair Miller, and members of the committee for the opportunity to speak in opposition to House Bill 5209 regarding shared appreciation agreements. And I think it's only fitting that I share my regard for Bruce's ongoing well-being. Get better, Bruce. So my name is Jesse Silverman, General Counsel of HomeTap, a shared appreciation agreement provider and a board member of the Coalition for Home Equity Partnership. And you've heard from some of the consumers, and you can hear some of the situations where consumers find utility in the product. As I often say, this isn't the right product for all people in all circumstances, but it absolutely is the right product for some people in some circumstances. And I'm just grateful today you were able to hear some of those use cases. And most importantly, I want to start by saying that we absolutely support consumer education and disclosure. We supported 25-115, which requires shared appreciation agreement-specific disclosures. That disclosure requires providing APR disclosures based on several different scenarios, different times in home value appreciation. In addition, we also provided ongoing quarterly statements to consumers, so consumers are aware of what they will owe. We also support additional educational requirements such as counseling. We supported that in Illinois. And as you heard from Vincent, one of the individuals that testified, our members are also provided counseling to some of the Connecticut consumers. And also to Andrew's point about usury, while traditional 30-year fixed rate mortgage rates are around 6%, home equity loan products like HELOCs regularly exceed the 12% limit this bill imposes only on shared appreciation agreements. And just as a final caveat, remember that there are state laws that ban unfair, deceptive, and abusive practice that already apply to shared appreciation agreement providers. So this is not an unregulated product. But as my time is short, I'd like to highlight three key issues with the specific language of House Bill 5209. And first, one of the most concerning is the requirement of mandatory refinancing. The requirement is a material concern to the industry and on its own, frankly, would functionally end the origination of shared appreciation agreements in Connecticut. And as proposed, this regulation is without precedent as it relates to other consumer financial products. By requiring providers to also offer a, quote, market rate mortgage to borrowers who can't satisfy their obligations without selling the property, providers would be required to fundamentally change the business models and become full-scale originators of traditional mortgage loans. To avoid allegations of improper steering, we would be required to consider a borrower's eligibility for both conventional and government loan products. Eligibility standards for shared appreciation agreements fundamentally differ from those applicable to traditional mortgages because the provider looks to the homeowner's available equity in the home to meet the future settlement obligations. Conversely, eligibility for traditional mortgage loans.
Wrap up your remarks.
In originating the original shared appreciation agreement, we believe the lender would be required to consider and verify the borrower's ability to maintain eligibility for and to repay a loan to be originated 10 or 30 years in the future. It's an impossible task.
Okay.
And with that, sorry.
No, it's okay. I was going to ask a couple of questions, and in fact, you anticipated my first one was going to be basically I have had a little time to go through the CHEP letter of testimony we received, and I think there are 5 sort of points that are highlighted here. You already touched on one of them. Fair to say that mandatory refinancing, I mean, would you, if you had to rank order them, is that the most problematic?
That's like choosing which of my kids is my favorite. I would say that would be a material concern. It's just functionally impossible to try and plan for 10 to 30 years in the future. I mean, we don't offer mortgages, and there was a comment made earlier that potentially we could partner with mortgage providers. That is certainly true. We could potentially partner with mortgage partners, but they would still be required to underwrite 10 to 30 years in the future. It's just not plausible. I would also say the usury cap is also potentially problematic. I would say equally problematic, but all 5 of them raise various concerns. Some of those can be fixed with, different language.
How about the fee cap, the third-party fee cap? I'm trying to get my head around that one. So we're trying to limit the origination, servicing fees, and so forth that happen at closing. But I guess I guess I'm not understanding what those third-party fees might be, and why it would be a problem to say have the borrower pay more than half of that cost, especially if those costs can be controlled in any way. I mean, help me understand what kind of fees that we're talking about there that are currently involved in these transactions.
Well, a lot of these are homeowner-driven costs. If you want to change title, right, that's a purely homeowner-driven cost. I would like to change who is on the title, right? That's just a sort of functional administrative task. Those are the kinds of fees that we're talking about. And again, I don't think that the prohibition itself is the problem. I just think that it's the specific language, in that it's a blanket requirement despite who is driving the cost as to who bears the fee. Does that make sense?
Yeah, and I guess I'm not being familiar with these transactions. I'm not sure what the fees actually look like and what the origination looks like. And so
I think in many cases it's just like a traditional mortgage, right? If you're going to change, one of the examples we provided, we're conveying the property to a living trust, right? That can happen with a traditional mortgage as well. And that's something that's homeowner driven. We have no problem with, but we believe the homeowner should bear the cost of those changes.
Well, I think what they're getting at here is particularly it says origination. So if there's some kind of points or lender fees, they're looking to cap those. So I think that's what they're trying to get at, where this provision came from. But I guess a question for you then is are you aware of any similar requirements under TILA or anything that are applicable to the conventional mortgage industry that are similar to this, or is this something unique that we're
I don't. I'm not aware, but I'm not aware as I sit here, but I'm also not comfortable saying that they don't exist.
Yeah, I'm just trying to.
I believe it's unique to cap third-party fees.
Okay. I think I am good. I see no other questions. So with that, I will thank you for joining us today, Jesse.
Thank you for the time.
Appreciate it. All right, we're moving along here. Melissa. Yes, Melissa is with us. Melissa Hartfield.
Hi. Oh, sorry. Hi. I need to take off sharing a virtual background. I apologize.
I see that. I can't tell what it is. But
Just my face with the
off,
hat.
off now. Okay. All right.
Yeah.
We're good. Thank you for joining us. You
Thank
can
you.
proceed.
Thank you. Well, welcome. Thank you for letting me join. I want to say good afternoon to the members of the banking committee. My name is Melissa Hartfield. I am a homeowner in Wilka, Connecticut, and I came on board to share my experience thus far with Point Home Equity, and expressing my concern and opposition for HB 5209. Right now, I'm new in the process of applying, and I just wanted to speak of my experience thus far. They do provide educational information before you proceed with the application. So a lot of people had spoke of their experience and they didn't add that to that. Before you even complete your application, you have to go through a visual training video, and then you have to get, I think it's 90 or above as far as correction of the questions to make sure you understand what you're getting into. And at the end of the loan, where you're selling, it is a 12%, which you're fully aware of, and you do have the option to pay it off early. I did want to speak on that. This is the only option that I can have at this time because the other financial options had denied me and wasn't a good fit. There was a mass layoff the early part of this year in the company that I was in. And due to that, I'm in the financial hardship. I have been actively looking for work, but then I had a couple of health issues to where I had to have multiple procedures done. That in itself had made extra hardship on me. So I did not qualify because my credit score wasn't high enough. The banking had said to me, and as far as every option that I had, they kept saying, well, we can't help you at this time. Come back after you fix X, Y, and Z. So this option, to me, I understand the pros and cons. And I feel that the flexibility of having no payments at this time is definitely a benefit for me. And even though I haven't completed the full funding yet, I'm in the process of it now. I do have full clarity, like I said, of the path I'm going forward on. And I have confidence in the equity that's in my home. My home was, I bought it and has grown in equity since I bought it. And I just had gotten an equity report that they had just did last month, the town. So I know how much that the HEI will get in the point of sale. But I just wanted to come on board just to speak on that.
Thank you, Melissa. Thank you for joining us. I don't know how much of this hearing you watched, but there are others who kind of relayed their stories as well and how they arrived in looking at this product as an option. And you were very, I think, clear and concise in describing your circumstances. And I want to tell you, it totally makes sense that, you know, you would, if you need the help and you're not able to access sort of the traditional mortgage market, then, you know, yes, you're stuck. And I can understand that. I wanted to ask you, you started to talk about it at the end there. So what is your understanding of the value of your property today? What your, you know, debt is currently on the property, how much equity you have in the property? And then the second part of that question would be, so say you went and sold the property a year, what's your understanding of how much you would owe at that time, or how much of that equity that you would recoup and how much would go to your lender?
Well, 12% would go to my lender and the rest I would recoup. Since I have purchased my home, the equity have gone up. I would say right now, what I owe in the equity I would get a still a large portion.
Okay, so what are we talking about? What's the value of your property? You said the town just did
Yeah, the value of my property is about 300,000. And when I purchased it for it was about 200.
Okay, and so again, just to understand the terms of your deal, it's just the 12% that you would owe at the time that you sold.
Correct.
Okay. Any other questions for Melissa? No. Oh, I do see Senator Miller's hand up. Senator Miller.
Thank you. And hello, Melissa. And I'm sorry that you're going through this, you know, these difficult times. And I wish you the best. I hope there is some light at the end of your tunnel, because to lose your job and then your health, you know, be faced with health issues and not being able to pay your bills, I know it's difficult. And I know that personally. So Melissa, I appreciate you testifying today, and I just need some clarification on how the product work, if you can help me. So your house, you said, is valued, like the equity is about 300,000. Is the equity 300,000?
The equity, actually, no, my house would sell for 300,000. I'm sorry. The equity is right now to date a little over 68,000.
Oh, okay. Okay. So out of that, so for 68,000, you would only have to pay the provider 12% of that.
Or
And
I have
so
the option for buyout early too. So if I wanted to pay it back before I would sell, then I could do that as well.
So do those terms change at any point during the contract period? So for instance, if you haven't paid in 10 years, let's say the contract is 10 years and you haven't paid in 8, it's still 12% of whatever the equity is. The
Up to
equity,
30
that
years.
amount is fixed. Oh, you're 30 years. Okay. So that amount is fixed. And so there are no other payments that you have to make and no other fees?
No.
Okay. All right. Thank you. Appreciate it.
You're
Really do
welcome.
appreciate you coming before us.
Thank you. And I listened to the whole session so far since the
Well,
beginning.
thank you. We appreciate that too. It's a long day.
Thanks for hanging with us. I was going to ask if you were here from the very
Yeah.
beginning. So yeah, really appreciate you joining us and your patience and spending time with us.
Thank you. It's been educational.
Thank you. Okay. We're getting towards the end of our list. I have Matthew Gibbons next on my list. Matthew's here. Hi. Thank you, sir. Thank you for your patience.
Oh. Hi, everyone. Thanks for having me. My name is Matt Gibbons. I'm an attorney. I work out of Glastonbury. I used to work here in Hartford. And I'm not getting paid to be here today. This is not a work of advocacy. This is me participating in my community. It's something that I've found out that I am passionate about. And I want to talk to you guys about House Bill 5211. That's Representative Jacobson's bill regarding merchant cash advances. I think it's going to be most valuable for me to spend my about 3 minutes talking about some problems that I've seen in the way that merchant cash advances are working today. That is, problems with how they're implemented, things that I think you guys can solve, in part through Representative Jacobson's bill. So first, we've heard a lot about from previous testimony about why is this one product being targeted as opposed to loans or maybe mortgages or other products. Several speakers have testified about that. We've also heard somebody say that there's no way to establish what might be called a record of abuse here in Connecticut, unlike maybe in other jurisdictions. We've heard several people concede in at least one case or argue in another case that there's bad apples. I don't think that's up for debate. And then the last point I want to make is that earlier today we heard about how only a minor percentage of cases end up with successful defenses on the merits, these worst case scenarios for the merchant cash advance sellers or lenders, providers. And so I think that something's been lost in the shuffle here, which is just that, as with so many other things in life, there's two types of these things. There's the lawful ones and there's the unlawful ones. The difference legally here in Connecticut and in New York is whether the risk has transferred, the risk of loss of that money, the money that's advanced or loaned. If the risk transfers, that is, if the provider of the MCA faces a real risk of not recovering their money, that's not a loan. That's a product. That's a lawful merchant cash advance. But if the risk stays with what we would call the seller or the borrower, depending on how it is, if the risk stays with the person receiving the advance, then it's a loan. We're all familiar with this because not all of us have taken out loans, but if you have a house, you know that if you stop paying the bank gets your house. There's no risk there for the bank. I mean, there is, I'm oversimplifying a little bit, but that's a good way of thinking about it. So why is that important here? It's important because if it's a loan, okay, then the recipient has a very strong defense here in Connecticut, which is usury, under which the lender would not be entitled to receive anything. There's also causes of action. We heard somebody talk about RICO earlier, racketeering. The Second Circuit has affirmed a district court in New York which awarded summary judgment on RICO claim based on a supposed merchant cash advance. That is, the Second Circuit affirmed summary judgment. There is no question that these things can be sometimes RICO violations.
Your 3 minutes are up. Please wrap up your remarks.
In addition, here in Connecticut, we would have CUPPA cause of action. So it's true that these things are fundamentally different, but they're fundamentally different in very particular ways. Some are loans, and those ones need to be regulated. They need to be eliminated, really. And only this committee and the legislature are able to do that because the ones that are loans are masquerading as lawful products. And they can do that. They can agree in the contract. This is not a loan. They do it all the time. I've seen dozens of them. And they put it in the same contract 3 times. The stuff that you're paying is not interest. They put it in more than 3 times. And they will convince anybody who will listen that they're not loans. But the only way to regulate them is through this. Now, I'll conclude with this example. Well, it's actually not an example, but following up on a previous example. The senator had asked about a Louisiana borrower. And somebody testifying, it said, well, we need personal jurisdiction. Now, Senator, I heard you say that you're not a lawyer, but personal jurisdiction is a waivable defense. And what that means is that if the Louisiana company did not raise it according to our rules here, which they honestly have no reason to know in advance of being sued, and maybe, it comes in the mail and they find out late, then that defense goes away. The reality of the situation is that dozens and dozens, maybe hundreds, of cases are filed here, but also Connecticut businesses are taking these things out. They very well might think that they're loans. They very well might think that they're regulated in ways that they're not. They're taking them out and then they're losing the money. We're talking about daily payments of thousands of dollars. And then when they breach because they can't pay, then the merchant cash advance company frequently will then take them to court. They've extracted a significant amount of money already, and then they can enter into going forward a sustainable agreement. And so,
Thank you.
if there's any questions.
Yep. Appreciate it. Thank you. You did bring up one point, and I saw reference to it in some testimony. I haven't been able to review it yet, but if you wanted to what was the Second Circuit case that you referenced, and what was the issue and the ruling there?
I actually don't know it off the top of my head, and my computer died earlier today.
Okay.
All
right.
But
That's okay. Somebody submitted testimony that didn't testify in person today, referencing that. So I'm gonna look that up. I find that interesting. But no, I appreciate your perspective and bringing some color to it. You were not here, I don't think, last year. Some of these folks were here, and we had kind of similar discussion and exchanges last year. But yeah, I know, and I think your example on the Louisiana borrower, I'll call it a borrower, is helpful to describe what's happening here, because if they're waiving it unknowingly, then it's not then an issue, and that I think is the majority of the cases that we're seeing here. So thank you. Any questions for Attorney Gibbons? Seeing none. Thank you. Appreciate you hanging out with us today. Okay. Got a couple more on the list, but I'm not sure if we have. Oh, we do. We have Basil is not in the room. That was the next name on the list. Is that correct? No Basil? Okay. But we do have Mandala. Mandala, are you there?
Yes, I'm here. Let me
Hi.
just.
Okay, great.
Hi.
Hi.
Not sure the camera's but okay.
Sure,
That's
yes,
fine.
have you. We can see you and hear you. I appreciate you
Okay.
joining us. Appreciate your patience. Please proceed.
Yes. No, thank you for the opportunity to present. Obviously, this is a fairly important product, I think, which is available currently for Connecticut homeowners. My own experience is I am a homeowner in Easton, and I am self-employed. And being self-employed means you've got irregular income, which comes in at irregular times. It's very difficult to get a mortgage with that kind of income. And that was the experience that I had. So what I ended up doing was looking at several of these products. I am a financial professional, so I sort of understand a lot of the issues around the risks involved with this. And I eventually settled on Point. I did speak to several other companies. Some of them are actually no longer in business in Connecticut. And some of them, I think, are completely out of business, I think, for the reasons that are obvious, that they might not have had the right practices. But after looking carefully at what Point was offering, I chose to proceed with them. You have to go through quite a few educational steps. So the lady who was on earlier talked about having to watch videos. That's right at the beginning. And then when you go through the application and you are approved before the loan is disbursed, you actually have to go through a 30-minute counseling session with a human being on the other side of the phone, and they make sure that you understand what you're taking on. And this is an independent counselor, so it's not somebody from Point. It's from an independent loan counseling organization. Once you've done all that and gone through the steps, you then go ahead and they get a lawyer who comes in and you sign effectively what's a mortgage document. To me, it looked quite similar to what I signed for my mortgage. And that's basically what they use to, I guess, protect their position as a home equity investor. You are not obligated to make any payments in the interim. And now I took that product out in September. And as I said, in my business, I do get enough money, but it comes at irregular times. And the money is coming, and I'm in the process now of buying them out. And to be honest, I've looked at the calculations that they've given for the buyout letter, which I should be able to buy them out on Friday. And yeah, everything is fine, above board, accurate figures. So I'm one of those who would say I'm very satisfied, and it would be a pity if Connecticut homeowners lost the ability to have this kind of product. And I basically used it to invest in some other business and also just to bring some of my bills and credit up to date. And as a result, part of the reason why I can now go on is I was able to pay off a couple of loans that I had and significantly improve my own credit score, which would help with getting future loans. But banks for mortgages normally are very difficult when you want to borrow money and you've got any regular income. I think quite a few people would have experienced that. So yeah. So that's my experience. Yeah.
Okay. Thank you. And definitely appreciate your perspective. And again, sounds like you're very knowledgeable and have gone into this with quite a bit of thought and analysis of your own situation. And I think, frankly, we found that for most of the folks we've talked to. So appreciate hearing your perspective. I'm going to ask the same question. I don't know if you were on to hear others who, other homeowners who were testifying, to ask what is your personal situation, as much as you want to share, in terms of the existing value of your property and the equity you have in the property, and what the deal would be if you were to sell the property in a year, assuming that the value stayed consistent.
Yeah. No, I can definitely give you that. I've got exact values right now. The market value of my house, it's a 1.1 million. The amount I own my primary mortgage, which is at 4.25%, is 394 actually as of today. I just checked it. And the home equity investment that I took was 169,000, and I'm paying them back after 7-8 months, including all their fees. Probably after 8 or 9 months, I'm paying them back just on 180,000. So yeah.
So just $11,000 after you said a period of 7 months.
Yes.
Already closed, or you're in?
Yeah.
Oh, okay.
I'm in the process of it should be paid. It should be settled on Friday. Yeah.
Okay. Thank you. Any other questions? Senator Miller.
Yes, I'm sorry. Hello, and thank you for testifying before us today. I'm sorry, did you mention $11,000?
Yeah.
That's
so
what
only
you have to pay.
That's what they are taking as their portion. It's what they have.
I'm sorry, you cut out for a minute there. You said how much are they taking for their portion?
It's $11,000 out of a $169,000 loan. So their upside. So I'll pay them back their $169,000 plus $11,000 as the interest. So the way they structure it is that for the first few years, I think it's 3 or 5 years, they have a fixed interest rate, which allows you as a homeowner, if you're able to buy them out, you don't actually give them a share of your property appreciation. And it also protects you from giving away too much of your upside. I mean, since I took that loan, the houses appreciated significantly. If they were going for that upside, they would have made somewhere in the region of $150,000 on this. So they only took $11,000. So, but as you keep them longer, then they start to play more in the appreciation of value. Yeah. But because you can use that money to, say, if you've got credit issues, to clean up your credit, you can use that money to invest in a business, get cash flows, etc. I think for a lot of homeowners, if they were fully aware of it, it would be a good instrument to use to basically be able to use the equity in their homes to put themselves in a better financial situation and be able to buy out point within 2 or 3 years and still retain their homes, and most importantly, retain the low interest rates that they would have gotten on their mortgages if they got their mortgages a few years back. I had the option of going for a cash out refinance, but that would have meant I would have an 8% loan instead of a 4% loan. And that would be now on for 30 years, which it sounds great when they market it, not as good as maybe going for this option if you're looking at a short-term situation. Yeah.
Okay, so that's what it is. There are two options then. So it's the cash out.
No, the cash out is all offered by traditional banks. You can get that straight out of your FHA, out of your normal bank, M&T and the like. But with the cash out, you basically refinance at the prevailing interest rate, which is fine if the rates were low, but the rates were so high. So this instrument, one, you don't have to do that. And the second issue, which came up with certain people, was if you are not able to make the mortgage payments, for instance, your income is not high enough, there's no bank out there that will give you a home equity loan. Even your cash out would be difficult.
Right. So in your particular case, what happened to your mortgage? Did you pay your mortgage out of the 169 or they pay your mortgage?
No, I used that money to sort out some debts that I had and basically significantly boost my credit score, and also to put some money in an investment that I've been looking to make. And I've made that investment, and it basically is yielding some income for me now. Yeah.
But your monthly mortgage, you were able to pay your monthly mortgage, or the funder paid your monthly mortgage? That's what I'm trying to
No,
understand.
the monthly mortgage is still there. So they don't touch your first mortgage. So that's still the M&T bank. It's still at the same rate, same amount. Yeah. So all I did with that money is I increased my income through an investment, and I also reduced I wiped out all my debts. So I don't have credit card debt, car loans and stuff like that. Yeah.
No, the reason why I ask is because when I heard the other testifiers, they said that they didn't have to pay until the end of the contract.
Yes.
And that I heard some testimony regarding that, and someone else has said that too. And that's why I was just confused about your product.
No, it comes in as an equity. So it's like a home equity loan. It's like a HELOC. You don't have to pay that particular HELOC, which is this product. You don't have to pay anything, but your first mortgage remains and you still have to pay it. So for some of the people I had, they did not have mortgages anymore. Their homes were paid off, and they took this and they don't have to pay anything. For others, like the lady who just got off, she still does have a first mortgage, which you continue to pay. They just give her the equity portion, and she doesn't have to pay for that equity. In a traditional bank, if you went and took a home equity loan, you now have to service that home equity loan monthly. You have to make monthly payments. Yeah.
Okay, great. You're a great teacher. Thank you very much.
Thank you. Thank you.
Thank you for the explanation. Thank you, Mr. Chair.
Madam Chair, Senator Honig is now online, has a question.
Oh, can I grab a power bank for my computer? Is running low.
Excuse me, sir.
He had to go and get something, Mr. Chair.
Okay. Oh, okay. Oh, he's back.
Sorry about that.
Paul, are you there? You were muted before. Paul, you're muted.
Yeah.
I can't hear you, Paul. Paul, I can't hear you.
Does that help?
That helps tremendously. Now I can hear you.
All right. Well, thank you, Mr. Chair, and thank you, Mr. Sabanda, for your testimony. So if I'm understanding correctly, in your situation, you're paying off the $169,000 that you received upfront after just a few months. Is that correct?
Yes, I am. Yes.
And you have the option to pay this off at a fixed interest rate for the first few years. Is that?
Yes, indeed.
And
Yes,
would you mind sharing what that interest rate is?
yes, it's 18% per annum.
18%.
1/8, yeah.
1/8.
So it is high compared to normal mortgages, but the other option you would have is a personal loan, and those would be sitting in the 30s. So,
Oh, goodness.
yeah.
Okay.
Yeah.
And then when you originally took out this contract, you're giving them a percentage of the increase in appraised value of your home? Is that like if you held it for 30 years?
Yes, that's exactly how it works. So if you held it for 30 years, you give them a percentage, and they give you actual numbers to say if your home increases by so much, this is what you pay back. And so all that information is quite transparent and shared with you several times over. You also do get statements every 3 months. So I actually did receive some statements which showed me where I am with the loan. Like if I paid it off now, this is what I would pay. And if there was an appreciation, but if you hold it and your home goes up, you hold that thing for 10 years and you sell after 10 years, then they take a share of your upside. And I have to be honest, if your home appreciates a lot and you've held it, say, for 20 years, and your home goes up by doubles in price, they would probably end up taking 40% of the upside, you take 60%, or the other way around. Given the structure of these things. So it's a structured product, and you'd have to understand what it means. Yeah.
Right. And the percentage that in your particular contract is that 40%? Is that the amount that they would have taken if you had held on to the contract?
Oh no, it was lower. I think it was because of it depends on the amount that you take,
Yeah.
given the equity value of your, the total value of your home upfront. I think it was somewhere in the region of 27%. It was definitely
Okay.
lower than.
And if you would have taken more money up front, it would have been a higher percentage.
Yes. So they also give you a limit of as to how much you can take. For me, it was quite a bit. It was probably over 250,000, but you obviously take only what you need. Yeah.
Okay. Well, thank you very much. I really appreciate you teaching me about this product. And thank you, Mr. Chair.
You're welcome.
Thank you. I now have one additional question based on the last two exchanges with the two senators. So am I correct in understanding that your contract essentially had this early payout option, which you exercised? Is that accurate? It was a home equity.
That's offered to everybody. Yeah, on Point offers that to everybody. Yeah.
What are the conditions? Is that all? You said it's offered to everybody. Is that's implicit in the contract? There's always going to be this sort of early payout option, or is that something that you have to exercise or sort of negotiate at the time that you're closing on this?
Oh no, if you go to their website, it's quite clear. It is in the contract. You see it right up front. And it's also very easy to exercise the early payoff. If it was easier than my mortgage, my primary mortgage, when I asked them, what's your payoff letter on the primary mortgage? That took about a week. With Point, it took 24 hours exactly for me to get that payoff letter.
Okay. I think that's it for me. Seeing no other questions. I appreciate your time.
Thank you. Thank you to the committee.
Thank you, Mr. Sabata.
Thank you.
All right. And I think that has brought us to the end of our list. Am I correct? Is there anyone else in the room or anyone else that we skipped over? No. Okay. Seeing none. Thanks everyone for joining us this afternoon, and I will close this public here. What? Oh, hold on. I'm getting a motion. I don't, do we? The hearing? No, I think we're going to close the public hearing. Yeah. Hearing's hereby closed. Thank you.
Thank you, Mr. Chair.